I'm Brad Smith alongside Shauna Smith. This is Yahoo Finance's flagship show, The Morning Brief.
It's the last trading day for the second quarter and the first half of the year. While yields are moving lower this morning after the latest PCE data was in line with expectations and showed a softer spending. So let's get right to it. The three things that you need to know this Friday morning. Yahoo Finance's Josh Schaefer, Rick Newman, and Jared Blickery have more.
Stock futures in the green as investors digest the latest inflation data. Core PCE, the Fed's preferred inflation gauge, rose 0.1% in May from the prior month, in line with estimates, and slower than the 0.3% increase seen in April. Core PCE was up 2.6% over the prior year in May, in line with estimates. Now, the reading follows other promising May inflation prints, but Fed officials have remained cautious about inflation's trend, noting it won't be appropriate to cut rates until they have, quote, greater confidence in inflation's path.
President Joe Biden and former President Donald Trump tussled in the first debate of the 2024 election cycle. It was the first time they'd met since the 2020 campaign. Biden struggled with his delivery at multiple points during the debate. His poor performance left voters increasingly concerned around Biden's age, raising questions as to whether Democrats should replace him.
And Nike stock under pressure this morning, shares tumbling more than 15% after the retailer said it expects revenue to decline more than previously thought in the coming year. Nike said Thursday it expects revenue to fall mid-single digits in 2025, including an expected 10% decline in the first quarter as the company navigates a more challenging consumer.
Well, good morning, everyone. Let's take a quick look at Treasury yields moving lower after the latest economic data. PCE, personal consumption expenditures data, was in line with estimates. Investors eagerly awaiting the Fed's next move on interest rates. Now, the CME Fed Watch tool showing 67% probability of a rate cuts to come in September. For more on this, we're joined by Jennifer Lee, BMO Senior Economist and Managing Director here. And Jennifer, of course, we're beginning with this morning, just as we're thinking about what the market activity may look like as we round out the final trading session of the first half here, and what this really signals for the Fed in their own pathway going forward here. Does this move the dial?
Good morning, and thank you very much for having me on. I'm going to say that this report itself was probably the best that one can expect, and it certainly helps the Fed, I think, give them a little bit more comfort on their path to starting to ease policy, which we still expect to start happening in September. Obviously, you guys just went through the headlines, with a 0.5% increase in incomes and 0.2% in spending. But when you're drilling it down a little bit further, it was actually a little bit better, as I'm trying to say right now. Although that we were starting to see some softening on services spending. We've had 2 straight months of real spending of 0.1%, which is quite modest. And this is actually not a bad thing, because that's where all the stickiness of inflation has been coming in. So we start seeing some pullback or some cooling off in spending in the services side that will help cool the stickiness or unstick the stickiness of inflation. So that, I think, was a good thing. But at the same time, consumers weren't pulling back completely. They're still spending on discretionary items like recreational goods and vehicles and recreational services. So it shows that not everyone is terribly worried just yet, but we are starting to see some pullback on things like dining out. So there's some paring back. Bottom line to all this, there's some paring back, cooling in services spending, which will help the services CPI eventually start moving downward. And I think this is all good news for the Fed, allowing them to exhale a little bit and again continue hopefully on that path for a rate cut to come in September.
Yeah, so Jennifer, okay, so that's what I was going to ask you there. The timing then of that rate cut here, do you think it's more likely that the Fed is going to act then in September?
Yes, I think so. I mean, obviously we had that strong or that very encouraging May CPI number. And as Fed Chair Powell said, it's a good number, but we need more of them. And, so over the next couple of months, we're going to start accumulating more inflationary data. This is probably one of the bigger pieces that we saw since that May CPI. And, we need to see all the different inflation indicators all pointing in the same direction. And that will give the Fed the comfort and the confidence it needs to start cutting rates in September.
But Jennifer, do you think it's more likely, though, that the Fed is going to err err on the side of caution here. We talk about the risk here still to inflation, that we could see inflation rise just a bit. We talk time and time again about how this path forward for inflation is likely to be bumpy. Then wouldn't that, though, strengthen the argument that, hey, maybe it still makes sense, even though we have seen this progress, we are starting to see this disinflation, that it still makes sense maybe for the Fed to wait several months before cutting?
So we still have, a few more months before September rolls around, and for sure, I mean, if we had to, we're always asked, like right now we have officially 2 rate cuts for the Fed in September and December, and we're always asked, if you had to lean which way, which way would you be going? And we would sort of say that would err on the side of caution, as you just pointed out, and do fewer, I guess. But again, we still have a few more months of data to consume and to analyze, and again, nothing goes down in a straight line, and the path to 2% is going to be bumpy, but as long as everything is pointing in that same general direction, I think it will at least pave the way for at least the first rate cut to come.
The Fed likes to look and continue to carry the fact that it should be apolitical. To what extent do you believe that factors into their thinking as well here, trying to dodge any kind of closeness or proximity to the general election?
It's tough, and this is Fed's not alone. We've got the Bank of England, for example, dealing with their next election coming up next week. So we've got, for example, that's where we had the Bank of England, sort of holding off until after the election, and among other reasons as well. So I think the Federal Reserve is very cautious on that front, trying to, as you say, dodge any bullets that could potentially coming from this election. But we do have them pausing in November just to see how things fall out before moving again in December.
All right, Jennifer Lee, BMO, a senior economist and managing director. Thanks so much. Let's talk about another big story that we're tracking, and that is the first presidential debate happening last night. President Biden and former President Trump kicking off their first debate of this election cycle, blaming one another for the state of the economy and inflation.
What we had to do is try to put things back together again. And that's exactly what we began to do. We created 15,000 new jobs.
Well, despite inflation being top of mind for many Americans, something else really dominated the debate: President Biden and former President Trump's performances on the stage. Here with Debate Reaction, we have Kim Wallace. He's Senior Managing Director of 22V Research. And also with us, we have Greg Valliere, Chief U.S. Policy Strategist of AGF Investments. Great to have you both. Kim, let me start with you. In terms of Democratic side here, the Democrats were looking to reassure Americans that we have made progress on inflation, that the economy is actually in a strong state. I'm curious to get your reaction to last night and whether or not it backfired.
Oh, I don't think anything but backfired. The goal for each of these guys last night was to reassure their base, not have any erosion of the base, and to not alienate undecided voters and dependents. Former President Trump didn't violate that theme. It's hard to say that President Biden will be able to repair quickly the damage done to both the base and his attractiveness to independents.
Greg, I was looking through your note this morning here, and you actually put that in your bottom line here, quite frankly. And your bottom line tentatively was that Biden will drop out within days, giving an opportunity to a fresh young face. I want to get your reaction to the debate, and also who the markets or anyone out there, some of the Fortune 500 CEOs that even have said that they might not side with Trump, but they also saw last night's performance from Biden, what their kind of calculus is that they're running this morning.
Well, it was a disaster. It was a debacle. I agree with Kim that they did not accomplish what they were hoping to do with their bases or with crucial support. No, in terms of someone new coming in at this late point, it's a process. I don't think it'll be resolved in a day or two or three. I think we've got to see how polls look. We've got to see how the party is. But I can tell you, and I'm sure Kim would agree, that during the night, there were an awful lot of emails and texts from Democrats who are now really worried about losing the House, the Senate, and the White House.
Kim, do you agree?
Greg, good to see you again. It's been a while. I completely agree. The texts and the emails started about 10 minutes after 9. They continued through 1 a.m. this morning. I turned it off after that. it will be a contentious process to select someone other than Biden to run against President Trump. But my betting is that's where most of the money in the Democratic Party and most of the core supporters, the leaders, are this morning. It's very difficult to avoid the fact that President Biden no longer seems viable in this election. We'll have some feedback. He's in North Carolina. He kept that schedule. So we'll have some feedback this morning. I agree with Greg. It's very difficult to come back from this.
Greg, what does this mean for our viewers out there, the investors trying to figure out if we do see Biden drop out of the race, the Democrats ultimately end up putting somebody else in the front there to run against former President Trump? Is that going to add instability? Does that add volatility? How do you see that playing out?
Yes, volatility, instability, you name it. Kamala Harris would logically be next in line, but as you know, her polls aren't good, and there's a feeling she may lack the gravitas for the job. As far as Gavin Newsom, he's in the middle of a huge budget crisis in California, self-inflicted, I might add, and I don't see Newsom. So they're going to, if they decide they have to look elsewhere, I think there are several governors headed by Gretchen Whitmer of Michigan, maybe Josh Shapiro of Pennsylvania, but they're going to have to look at other governors. Kamala Harris is not a shoo-in.
Yeah, you mentioned two governors in major swing states as well here. You know, another big election issue hit last night, and that was Trump's tax cuts, which are set to expire next year. Trump touted the success of his policy while Biden defended his own stance. Want to play this quick clip and now get your reaction on the other side, Kim.
The tax cuts spurred the greatest economy that we've ever seen just prior to COVID. And even after COVID, we took in more revenue with much less tax, and companies were bringing back trillions of dollars back into our country. The country was going like never before, and we were ready to start paying down debt.
The fact is that I said nobody even making under $400,000 had a single penny increase in their taxes, and will not. And if I'm reelected, that'll be the case again.
All right, so one element where AI could probably be used, especially in fact-checking in real time, perhaps here, Kim. You know, as you're hearing all of this discussed, what is this set up for what Americans should expect to be the core and central debating point around taxation?
It's a good question. It will be relevant. It will be a lot more relevant in the first half of next year than it is today. And it's certainly not important to Democrats right now. But to answer the question, fact checkers paradise last night throughout this debate. That's not the story. The story is one guy prevailed, Trump, in a setting that was negotiated by the Biden team. And the other guy did not show up. The person we saw at the State of the Union was not available last night. Greg's right. Democrats are going to be thinking about who replaces him. Another name you have to throw into the mix, whether you want to or not, is Hillary Clinton. She will gather some support immediately from donors and some of the leaders of the party.
Do you think she could be a candidate there, Greg?
I think that if the party is desperate, what's the old saying? Desperate times require desperate measures. You can't totally rule her out. I kind of rule out Michelle Obama. She hates politics. I think that would be unlikely. But yeah, I'm sure there'll be a boomlet for Hillary. My take would be that within the party, she's pretty much a pariah right now.
Okay, and so
Greg's point is right, but you know, it goes back to something he and I have both said. The way forward is contentious for Democrats. There's no way around that. Realistically, there is absolutely no way to do this smoothly, but they have work to do and they know it.
I mean, is there either side that's actually getting across an agenda at this juncture? Kim, I'll go to you first.
I'm going to go back and gently dissuade you from thinking in those terms. No one else is thinking about that inside of politics this morning. On the Democratic side, it is all crisis management. On the Republican side, it is taking advantage of the momentum that was handed to them as a gift and protecting it, growing it as they go into Milwaukee in July. To answer the question, policy agenda hasn't really been foremost in this campaign, which has been a campaign from home for both guys for different reasons. And I don't expect policy to matter much in the next week or two.
Greg, I'll lob the same question to you. I mean, with the additive that a lot of people who are trying to figure out exactly what they saw last night and the lack of pushback on kind of both sides there ultimately, and clearly that Biden missed on some of the alley-oops that should have been there for his own camp. And I imagine many people still trying to figure out what black jobs actually are at this point. All these things considered, I mean, there were several snafus, and clear as they were, are either of these candidates in a good position to govern for 4 years should they take office?
No, they're not. They both have huge flaws, and I think it'll be difficult. Let me go back to one point really quickly. You mentioned tax cuts. They were discussed last night. My sense is in the last few weeks, a lot of members of Congress, including Republicans, are beginning to get cold feet about extending or even expanding the Trump tax cuts. That's another $4 or $5 trillion. And I think a lot of members of Congress are getting worried that our total debt of 34 trillion is unsustainable, and we may have to look at a more restrictive fiscal policy.
All right, Kim Wallace, Senior Managing Director of 22V Research, and Greg Valliere, who is the Chief U.S. Policy Strategist of AGF Investments. Great to have you both here, and thanks so much for your reaction to what we saw yesterday evening.
Sticking with the presidential debate, President Biden and former President Trump going back and forth over key issues, including the economy and foreign relations. But last night, it left voters increasingly concerned about something else.
What we had to do is try to put things back together again. And that's exactly what we began to do. We created 15,000 new jobs.
President Biden meant to say the economy added 15 million jobs instead of 15,000, while former President Trump was quick to fight back.
The only jobs he created are for illegal immigrants and bounce back jobs, a bounce back from the COVID. He has not done a good job. He's done a poor job, and inflation's killing our country. It is absolutely killing us.
Yahoo Finance's Rick Newman joining us now. And Rick, I think the question, we were just talking about it with Greg and Kim a moment ago, but can the Democrats defend Biden, or what do you think happens next?
We had guests just a moment ago giving the case for why Biden needs to go and what Democrats are going to do. There's another point of view that I'm also hearing, which is, first of all, the only one who can decide whether Joe Biden drops out of this race is Joe Biden. Okay. The other point of view is everybody overreacts to debates. Everybody inside the Beltway and inside the political culture thinks everybody in America watched this debate. Everybody analyzed every single thing they saw, when the reality is, a lot of the swing voters that are going to determine this election probably didn't even watch. Now, they're going to be hearing about it. They will probably watch, or they might watch the next one in September. Here's one thing to think about while we're all, playing the political game, like who could the other candidate be? I think the most important person in America right now is Jill Biden, Joe Biden's wife, because if Joe Biden personally does not decide to drop out of the race, he remains the candidate. And guess who might be the one person who could say to him, it's time to gently step aside, take a bow, and accept all the accolades of the party and let someone else? It would be his wife, Jill Biden. So when Greg Valliere said he expects this to play out, but Biden to drop out by the weekend, I have my doubts.
Of what you heard last night, I mean, you are kind of really sharp on the fact checking very quickly. Even as we were playing some of the shots, I saw you shaking your head here. So what were some of the most egregious that come to mind for you from what we heard?
Well, the Biden campaign has put out 50 Trump lies from the debate. I did a cursory fact check of them. I think they're more or less right. So let's say Trump told 50 lies. I think that's in the ballpark. He's wrong that all the jobs since under the Biden administration are bounce back jobs. Total employment now is higher than it was before COVID. We didn't just get back to where we were before COVID and stagnate. We keep going. Job growth has been surprisingly robust for the entirety of the Biden administration. He said that Biden's letting undocumented migrants in so they can join Social Security and get free benefits without taxation. Completely false. It was. I mean, you have to question the usefulness of the debates on the substance, because there's just vast amounts of misinformation. I mean, you could almost argue There's as much that's false as is true in these debates. So the whole format has just become kind of misleading. I will say Biden got we pointed, he said 15,000 new jobs when in 15 million. Another point, he said there are 1,000 trillionaires in America when in fact it's billionaires. He got his words wrong, as Biden has kind of done for a long time. What I thought was more worrisome were certain segments where he just could not finish his thought. He started on, at one point, some explanation of how he handled the COVID situation he inherited from Trump. He couldn't get that thought finished, and he ended by saying, look, we finally beat Medicare. I have no idea what he was talking about, and I think that his preparation for the debate, which obviously was, call up all this data, these statistics. I mean, he was rattling off numbers, which he is terrible at this point. That's the number one thing he should not be doing, is trying to remember all these numbers. Trump didn't do that. Trump honestly just makes up numbers, and he makes his claims. We had the greatest economy ever and stuff like that, where Biden is trying to, and by the way, Biden's going back in time, what happened in his first year, his second year. Americans want to hear about the future. They want to hear about what's coming next. And by the way, I have to say this, the most ridiculous thing in the debate was at the end when they were arguing over who had the lower golf handicap.
Brad tweeted about that.
I mean, why did Biden take the bait? I mean, okay, Americans.
Why take the bait?
So all Americans want to know, who's the better golfer?
No, nobody. If you care about the future of the country and who's leading it and actually prioritizing, making sure that we have good relations internationally, that you have a booming economy, that you have a safe border as well. I mean, all of these things considered, I don't care who can hit a golf ball farther at the end of the day, and a lot of Americans.
I mean, let's have a golf match. Seriously, let's put these guys. I want to have a presidential. Forget the next debate. Let's have a golf match. Yeah. They have to walk the course, okay, like real golfers. They can have a caddy, but I want to see. I want it covered like the Masters. Every shot, I want to see the ball when it flies into the weeds or hits the tree, and I want to see them walk over and hit. Get out of the rough.
And no cheating.
Yeah. For a presidential debate. That's what happened. All right, everyone. Rick, thanks so much. We'll be seeing you throughout the day. All your markets action straight ahead. Stay tuned. We've got about 10 minutes until the opening bell. You're watching Morning Brief. Shares of Nike slipping this morning as the athletic footwear and apparel company. It reported earnings after the close yesterday, slashing its full year guidance. The company said that it expects sales to drop 10% during its current quarter and warned of soft sales in China amid a more challenging consumer. For more on this, we're joined by Amanda O'Neill, who's the Consumer Products Director at S&P Global Ratings here. Amanda, great to have you here speaking Nike with us this morning. I mean, want to just get your read in on what we heard from the company and especially how they're navigating this consumer mindset and environment.
Thank you for having me. Happy Friday.
Happy Friday.
Yeah, Nike, it was surprising that Nike, is expecting revenue declines next year. The company, was flat this year for revenue. Last year, they grew 10%. So we saw a sequential decline throughout the year, but they noted many challenges, right? So we know that the macro is weaker. They've lost some traction in their digital strategy and have had to shift and pull back and move more into the wholesale channel. And that's going to take time, and that is going to hurt their results for fiscal 25. We know that from what we heard on the call, that this looks like it's just going to be a fiscal 25 challenge, and that they expect to have momentum from new innovations hitting the marketplace to start growing in 26. What would concern us from a credit perspective is if this trend continues into 2026 and the company isn't able to remedy these revenue declines.
So, Amanda, when we talk about what Nike needs to do to turn that momentum around or regain their momentum, they blamed a lot of the slowdown or misses here on weakness in their lifestyle brands. I guess, how much do you think that argument has traction? And then what do they need to do in order for their turnaround efforts to pick up some steam?
Right. There's a, some thought in that because they were so focused on growing their internal and their digital capabilities and growing on their own direct-to-consumer digital business, that maybe they missed on some innovations in running specifically. And the consumer, shopped elsewhere. We've seen other brands really come into and gain popularity and take some share, those being Hoka and On Running, for example. New Balance has also gained traction. So for Nike, what they really need to do is continue to focus on innovation. They're going at it from a more balanced approach than digital focused. And they're trying to meet the consumer where they want to shop and really hone in on some of the key trends in consumer, which include, comfort, athleisure, and really focusing in on sport.
Innovation, it costs. I mean, you got to spend heavy into that and hope that it sticks with consumers as well. Where do you think that division is that Nike can lean into where innovation will shine through and they'll be able to pass that through to the rest of the business?
Yeah, so Nike toted on the call that, they have a vault, right, of products and a portfolio of that they can continue to, bring back and, recreate them and grow, such as they did with, revamping, if you will, such as what they did with Jordan pre-pandemic. So they believe that they have the products and the innovations ready. They're also pulling forward a lot of innovations that they had planned to reset the marketplace. They are also investing $1 billion in, consumer-facing marketing and to really showcase these innovations at the wholesalers in the retail channel to really drive that brand heat.
All right, we're tracking the swoosh here going into the start of today's trading activity. Amanda O'Neill, Consumer Products Director at S&P Global Ratings. Thanks so much for joining us ahead of the opening bell.
Thanks so much for having me again.
Certainly. It's time for some trending tickers. Trump media shares moving higher on the back of last night's presidential debate. The move comes after President Biden's performance raised concerns among Democratic voters. I believe you were taking a look at the stock action from yesterday. Extended hours here this morning, we had seen DJT actually moving higher here by about 8%. And so as we're continuing to take a look at that longer term chart as well, it is worth noting that there has been some slippage, especially over the course of the last month, where it's down some 20+%. And year to date, still holding on to some very solid gains, but it's a larger question of what profitability looks like for this company and if that even matters. It's so detached from fundamentals because of where investors are using this as a proxy for their own support of former President Trump.
It certainly does trade independent of fundamentals. I mean, even when you take a look at it, just a 5-day chart, you're looking at a stock that has soared more than a third here and then up another 8% here ahead of the open. So again, we're seeing once again that investors are pouring their money into this stock. And we know that this stock, like you just said, tends to trade around the sentiment surrounding former President Trump rather than the fundamentals. So I think the early reaction, whether or not this sticks here, but the early reaction obviously was that former President Trump came out on top, at least when you're talking about this debate. Lots of questions from Democrats just about what exactly that path forward looks like for President Biden at this point. So as a result of that, we're seeing a Trump media stock here move to the upside here at the open. All right, that is the opening bell here on Wall Street as we kick off the final trading day of the second quarter and the first half of the year here, Brad.
Oh my goodness, look at the folks over at Loomis ringing the opening bell at the Nasdaq, everyone. Okay, and then at NYSE, you got the LB, not to be confused with LL Bean, I guess. Well, that's 2 L's and a B. So anyway, I messed that up. It's Friday anyway. Some funfetti. Let's get to it. We're taking a look at the major averages here. We've got some mixed activity out of the gate here. Dow Jones Industrial Average, you're taking a look at some declines right now by about 0.1%. S&P 500, that is moving higher by about 0.1%. We'll be generous and round that off too. And the Nasdaq Composite, that higher by about 0.1%. So not a ton of movement. It's a day, of course, where the markets are digesting what the heck they actually saw for the traders that did tune in last night to the presidential debate, and also to an as expected PCE report that came out on the economic data front this morning, perhaps giving a little bit more of the focus towards what the Fed may do. But as it came in as expected, not too much movement to be expected on the back of that report here.
Yeah, some signs of slower inflation, though, so at least we're seeing that reaction play out here in the equities market and also the bond market with yields moving lower. Let's kick it over to Jared Blickery, who has a closer look at that movement here this morning. Jared.
Shauna, we are seeing kind of a mixed market today. As you said, not a whole lot of movement in the indices, and the S&P 500 and the Nasdaq Composite are set to be up 9 of the last 10 weeks. So even though we're not seeing a lot of action today, we have seen a lot of action over the last 2-3 months here. So here's the Dow over the last 4 days. Let's punch this up to 5 days. You can see just about break even for the week. Here's the Nasdaq Composite putting in a respectable 1% gain. S&P 500 a little bit less, about half of that. And I'll also show you the S&P 500 equal weight down 0.5%. So that's just showing you that the mega cap's a bit stronger than the rest of the market there. But interestingly, complementing the mega caps, you also have small caps doing well this week. So the Russell 2000 up about 0.8%. Also, Russell indices, and it's not just 2,000, it's the 1,000 and the 3,000 and a bunch of others. They are rebalancing today. That happens after the close and doesn't mean a whole lot for retail traders, but there's going to be a lot of liquidity at the end of the day for big institutions. So take that as you will. Now, here is the S&P 500 sectors. We have energy in the forefront, but I want to show you what's been happening this week. Over the last 5 days, we have energy in the top spot, then communication services. That's a Meta and Alphabet story, and then consumer discretionary, which is an Amazon and Tesla story. So we are seeing the mega caps outperform. Nevertheless, you will see, and notice here, NVIDIA down about 2%. That's Amazon, but NVIDIA down 2% for the week. And in general, chip stocks have been a little bit of a rough go. You can see semiconductor stocks, Broadcom down about 4% this week, Qualcomm down 7%. Contrast that with software, solidly in the green. So within the tech sphere, we're seeing kind of a dual story there. And you can see a lot of these names like Salesforce, Adobe up about 4%. So even looking into disruptive tech, see there's some of the smaller names without a lot of profits, a lot of these doing well too. So just not the best week for semiconductors.
All right, Jared, thanks so much for breaking that down for us. We'll keep right here on Yahoo Finance. We've got much more of your market action ahead. Again, we're just 3 minutes into the trading day. We're looking at gains for all 3 of the major averages trading just above the flat line. We'll be right back.
It's a jam-packed hour focusing on the biggest movers and shakers on Wall Street.
This is market domination, and here, every day is game day.
We have 1 hour left until the market close.
It's game time for investors to make their final plays.
The clock is ticking, and we've got you covered with our quarter-by-quarter playbook.
We're bringing you in on all the market action.
with step-by-step analysis of our biggest trending tickers.
And expert insight into the day's biggest headlines.
We'll bring you the closing bell and get you to the finish line.
This is
Market Domination. Tune in daily from 3 to 4 p.m. Eastern.
Stocks moving higher in early action. We've also got yields under pressure after the Fed's preferred inflation gauge showed progress on inflation. So here to discuss what this all means for the market and what this means for the Fed moving forward, we want to bring in Marvin Lowe. He's State Street's senior global macro strategist. Marvin, it's good to see you here. So we're looking at some relief maybe in the markets just in terms of what this could mean for the Fed. Do you think this print makes it more likely that the Fed might act sooner rather than later?
You know what? I think at the margins, it certainly confirms a view. If you believe that they might go in September rather than December, it's a possibility. But the number came in pretty much as expected. It continues to show the disinflation that the Fed is needing to see. But, there's still other components within the economy that it needs to get comfortable with before it pulls that trigger, if you will. But, certainly at the margin, if you thought September was a possibility, it gives you a little bit more comfort on that.
And so if September is a possibility here, one of the major things that we're trying to figure out is what employment or unemployment would tick to, and then ultimately as well, where inflation would continue on its own trend. What are your estimations by then?
Yeah, I mean, for sure. So, this was an encouraging number. Absolutely. One of the things that we look at when you kind of go through the details, if you will, is that these are year-over-year comparisons. So, if you had very low inflation numbers last year, in order for inflation to go down this year relative to last year, the number has to be as weak, if you will. So those base effects, in terms of how we look at things, become more challenging. So you could actually see inflation tick up over the course of the next couple of months before it stabilizes. And I think that's one of the challenges for the Fed, is that you're going to have this up and down kind of movement going into the fall. So it might not be as clear as what we're seeing today.
Do you think that even in that trend that markets could continue to notch new all-time highs?
Yeah, I think it is supportive. I think keeping the Fed in the story from a rate cutting perspective is powerful. We're coming into earnings season. Those numbers look pretty solid. And really looking at growth expectations around earnings for 2024 as a full year and 2025, it still shows that there's strength within the corporate earnings space.
Marvin, I want to switch gears a little bit and talk about what we saw last night from the presidential candidates, former President Trump and President Biden. And I bring this up because a lot to talk this morning about whether or not Biden is going to continue in the race. And my question to you is how you're viewing this from a strategy perspective. How big of a risk maybe this potentially is, the uncertainty to the market?
Yeah, I mean, for sure, the performance of both candidates were interesting. I'll just leave it at that. Kind of looking at the odds market, if you will, another Trump presidency became a much larger possibility ultimately. And, how we look at things is that when those odds go up, you have to look at those policies that might come along with it. And really, whether or not we're talking about tariffs, whether or not we're talking about a much more lenient tax environment, you do wind up with inflationary pressures. So that is certainly one of the things that are in the back of our mind. Kind of having said that, a lot can happen between now and November, as well as real policy versus what some of these candidates might use when they're stumping around is often very different.
Marvin, given that, though, that there's so much uncertainty, is it likely to add to some of that volatility that we could see leading up to Election Day?
You know what? It's going to be isolated. I think the markets generally will look at a Trump presidency as more market friendly. Less regulation. Potentially less taxes. From that environment, it does provide support. But you're going to get nuance. You're going to get volatility in certain sectors that might benefit versus others. So yes, political risk is something that you need a premium for. And we're seeing that really play out in Europe as well as the other emerging markets as some of these surprises keep coming up on the political side of things.
One of the parties right now seems like it's 3 weekends away from Weekend at Bernie's. So all of these things considered, if we were to see a swap in or some type of new candidate emerge from the Democratic Party, what would that do for markets? What would the reaction be there?
I mean, you said that rather than I did, right? But we'll certainly parse the viability of that candidate. It does come down to 6 states. It comes down to how those candidates are divided. And really the calculus, if another candidate emerges, how successful can they be? Does it really change the concern that the Democrats have now, and really the way the markets are leaning more heavily that the debate really assisted another Trump administration?
Marvin Lowe, State Street Senior Global Macro Strategist. Marvin, thanks so much for taking the time here with us this morning.
Thank you.
Certainly. Apple's iPhone sales in China showing its discounting may be paying off. We'll discuss this after the break. Apple's iPhone shipments climbing 40% in China during the month of May from a year ago, according to research firm affiliated with the Chinese government. The move was slightly off April's growth pace as the tech giant doubles down on discounting here. Here you're taking a look at shares right now, up by about 0.2%. Of course, for Apple, it's really going to rely on this next wave and this next cycle. Perhaps the iPhone that's announced not only in this coming September, but the amount of people that rotate into iPhone 15, something that has the operating system that's essentially going to be able to power some of these new generative AI capabilities that they had touted at WWDC. And that's where we could potentially see even more of these shipments start to emerge a little bit more, not only in China, but I think another major region that's going to be critical for Apple here within that regard might be India as well here. So US, India, China, for Apple right now continue to be the most considerable plays that they have internationally.
Yeah, certainly. When you take a look at the increase of demand that we are seeing, a climb of 40% in May, it's significant just because of, we talk about the fact that Apple has been losing market share against some of the domestic players inside China. It's hard to appeal maybe to a stronger base. There are more consumers at a time like this, especially amid those heightened geopolitical tensions here that we have seen between China and the U.S. government over the last several months. So again, obviously, when you take a look at the climb, and a climb as significant as this early data showing of 40%, it's also important to point out that this is at a time when smartphone shipments climbed only 13% overall, but foreign brands there growing almost 4 times faster, so really outpacing some of the growth that we saw from those domestic brands. But again, China, a key country, obviously a key region for Apple. We talk about the importance to it for future growth here time and time again. So again, gaining even more traction inside the country, clearly viewed and should be viewed as a win here for Apple.
I mean, it took us all the way until May for Apple to really join the rally here that we've seen over the course of 2024 here, where there have been new all-time highs notched. Apple for 5 months, essentially, or almost 5 months, was left out of that. It's really in recent weeks, in the month of May and June, that this company has decided to join in on some of the action here. And during that time, since the beginning of May, essentially, has been able to run up by about 24% here. And so all those things considered, it's really coming on the back of what they were able to announce about when they would actually join into this broader theme and the thematic play for a lot of people of AI, but also where they would be able to show that they can navigate a consumer environment that is pushing back against some of the higher consumer technology prices, even if you don't have to replenish. This is demand generation. This is them triggering that next replenishment rate cycle.
All right, keep it right here on Yahoo Finance. We got much more ahead. We're talking the markets and how exactly the market likely performs in an election year, what exactly we should be expecting from volatility. We've got the VIX index up, when volatility is going to spike here in the markets in an election year. Looking back at historical data, we've got that for you next. The VIX has been hovering at just near historic lows this year, but is the presidential election going to change that? Here to discuss maybe the upcoming volatility that we could see in the market is our very own Josh Schaefer. And Josh, it doesn't look like the volatility has hit the markets just yet, but you've got a chart of the day for us here.
Yes, our chart of the day in the Morning Brief newsletter this morning came courtesy of our friend Keith Lerner over at Truist. And what Keith highlights is essentially you don't see a lot of volatility in markets until those two big bars that are sticking out on that graph, October and November. So you usually see a volatility spike in October leading into the election, and then volatility sort of dies down after the actual president is elected in that first week of November. And guys, I highlighted this chart this morning because I think the broad takeaway here is we're going to start talking a lot more about the election. You're going to start hearing a lot more about the election in the news, especially in normal mainstream news, maybe more so than our financial news. And the takeaway for investors is largely it's not impacting the market right now. It's likely to not impact the market really for a while leading into this election until you really get some uncertainty. I think today is probably a good example. You guys had our senior columnist Rick Newman on earlier this morning. You're talking about the potential of President Biden not actually being the candidate for the Democrats. The market is holding up fine, volatility isn't doing anything, and it's not really impacting stocks. So I just think it's an important thing to sort of keep hammering home to people that yes, this is a big story and it is something that matters, but it doesn't necessarily mean that you should panic when it comes to your investments.
Right, and I think that chart that we just had up on the screen, it actually is a perfect indicator of when people actually start, to your point, paying attention and deciding how they feel in the weeks leading up to when they're actually going to cast their vote too, and how they feel as well with the investments that they've made as well going into that.
And it sort of gets into, Keith got further into this in his note, talking about when you think about it, the president in terms of markets, you're really thinking about how it's going to impact the normal fundamental things that you would look at for the stock market or for individual stocks, right? You're talking about potential tax policy that could maybe later impact companies or something, overall macroeconomic plans that could later impact companies. It's not going to hurt earnings next quarter. It's not going to hurt earnings in 2 quarters, right? You're thinking about overall trajectory. Right. And so it's a lot bigger picture and not necessarily an easy read, unless you're buying DJT, and then maybe there'll be volatility.
Well, and we focus in on the top of the ballot, the president, but it's all those down ballots cast votes as well that are particularly critical to all of the things that could actually move where Congress votes, where ultimately we see the House and the Senate makeup that could either be logjam or could fast track what the presidential agenda might be as well that is campaigned on. And that's perhaps where it gets back into the thesis of what you were mentioning within this particular note too.
Yeah. Yeah, we'll check in on volatility in October, guys.
I was going to say, and you also got to ask yourself after last night's performance, if we do see somebody, if we do see Biden, maybe step aside. That's all the talk this morning. Maybe that's going to introduce volatility potentially a little bit earlier. But we'll see.
The final thing I didn't say on this too that I think is relevant, the reason we're talking about volatility is because we haven't seen volatility at all. And that is part of why we've been able to rally, right? If we were to see volatility, that is sort of the key, one of the key risks to the market rally that people are highlighting.
Certainly.
So that would be a concern.
That's why it makes a lot of sense. All right, we'll keep right here on Yahoo Finance. We've got much more ahead. New consumer sentiment. That reading's out in just about 3.5 minutes. We're going to dive into that next hour. Plus, we have much more on the first presidential debate. All that and more on Catalyst next.
Ever wonder why a stock suddenly drops double digits?
Or Bitcoin unexpectedly hits record highs.
We're unpacking the catalysts driving daily market action
and explaining the chain reaction.
Why are oil prices trending lower despite ongoing geopolitical tensions?
Or why a company's stock is up even though it missed on earnings. Insight from top strategists, economists, and business leaders will help you make the smartest choices for your portfolio.
This is Catalysts.
Tune in daily, 10 a.m. Eastern on Yahoo Finance. It's 10 a.m. here in New York City. I'm Shauna Smith alongside Madison Mills. Let's dive into the catalyst moving markets today.
The market focusing now more on the data than last night's debate. Consumer sentiment just crossing here, falling slightly. This comes after the latest PCE print shows inflation is slowing. So how will the Fed's preferred inflation gauge impact upcoming rate decisions? We'll discuss.
And prominent Democrats and donors raising concerns about President Biden's performance during the debate last night. We're going to dive into what this could mean for the election, what it could mean for your money in the markets.
And Nike is under pressure as China continues to be a problem for the sneaker maker. What does this mean for the company's turnaround plan? We're going to talk about that and more later.
All right, first we have some breaking data out on consumer sentiment coming in at 68.2. That was higher than at least what the street had been looking for, although it is lower from the prior month's reading. The prior month's reading was 69.1. This month coming in at 68.2. The expectations index rising to 69.6. That was up from 68.8 the prior month. When you take a look at current economic conditions index, that fell actually to 65.9. That was down from 69.6 the prior month here. Expected change in median prices during the next year falling to 3% versus a previous reading of 3.3%. We are seeing some reaction here in the markets this morning, Maddie.
Yeah, it's interesting, particularly given what we saw in response to the earlier PCE data. It looks like the Nasdaq is extending its gains as well as the S&P 500. I did want to talk about that PCE print a little bit here because it was so interesting seeing the fact that personal income is exceeding personal spending to a bigger degree here. And the wage component in particular up 0.7%, the strongest in several months. I've been kind of monitoring to see if we get actually some type of Pennsylvania Avenue reaction to this data about inflation slowing, given the reaction to the debate last night. So far, haven't seen any reaction there, staying quiet for now. But I am curious about goods deflating, that coming in the PCE print for the second month in a row. I wonder what that could mean for company earnings moving forward as we do start to see the price of goods deflating now for multiple months in a row. Also, the totality of this data, not to sound like the Fed, but does that lead to any kind of further concentration into tech if people are worried a little bit about a potential risk to the economy, the fact that we maybe have gone a little too high for too long on rates? Do we start to see people having a bit of a flight to safety reaction and a bigger concentration into tech? It's looking right now like that might be the case, given that we are seeing green across your screen, particularly the biggest strength in the Nasdaq so far today. Also looking at Treasury yields falling on the heels of this recent data. I'm going to take a look here at, you're seeing movement in the 10-year and the 30-year as well here, bigger on the latter end of the curve there. But we're going to dive into more market reaction here with Luis Alvarado. He's Wells Fargo Investment Institute's global fixed income strategist. Luis, thanks so much for making time with us this morning. I was just talking about personal income exceeding personal spending to a bigger degree and what that could mean for the Fed. And then we also got this consumer sentiment data in. Does all of this data warrant a conversation about lowering rates as soon as next month, in your view?
Yeah, right now, I think the Fed is got a good print on PCE, right? But I think it's too early. We can't have a victory lap yet. Like the Fed has been mentioning, it's very data dependent, but I think you have to see a continuity of at least 3 more months before we get some sort of better reaction from the Fed. So at this point, we believe perhaps that the July meeting is a non-starter yet.
What about September?
Yeah, September is actually looking very interesting. If you look at market expectations, the probability of September and December still kind of has most of the probability. That's also what we have penciled in. And I think that the key economic data that we're going to see over the upcoming 3 months is going to be more telling for the Fed if they're able to go ahead and cut rates. We see prints of a slowdown all over, but like was mentioned, personal income still there. Consumers are still feeling, strength from wages. They feel wealthy still as the market keeps on going up. So there's a lot of confidence for consumers. I know we get prints sometimes where the surveys are volatile month over month, but overall, we still see a consumer that is out there spending, and that is pretty much one of the most important engines that we've seen in the U.S. economy, at least over the past 18 months.
Yeah, there's so much data you can look at under the hood when you get these prints coming out about the strength of the consumer. And what's standing out to me is that wage component up 0.7%, the strongest in several months there. But what do you think is the single biggest data point? I want to say you're looking at a chart here showing the difference between wage and salaries versus inflation. And at the very end of your screen on the far right-hand side, you can see that big purple bar that's showing wages still staying higher for longer. And you can't even see the blue, which measures inflation next to it there because it's falling below the flat line. Luis, from your perspective, though, what is the single biggest data point that investors should be paying attention to understand the state of the consumer right now?
Yeah, that is an important, of course, indicator to look at when you're trying to evaluate what the Fed is going to be able to do. It's difficult for the Fed because that means that consumers are going to still do what they do best, which is consume. We're starting to see some other data showing perhaps more usage of credit cards, and depending on the tiers of income, you also see some discrepancies or differences between what consumers are doing. But it's difficult for the Fed if they really want to hone in on inflation. When you see numbers like this, they just are motivating consumers to still continue to go ahead and do what they do best, which is consume. So I would say the unemployment and labor indicator is going to be the crucial component here. I know the Fed has been looking at that more closely to see if they have some leeway, if they have some capacity to be able to cut eventually, if the unemployment rate starts ticking higher, if you're starting to see more unemployment claims rise higher and then new initial claims starting. But for now, it's so early that you still don't see any patterns or any trend developing there. But we know, because the Fed has mentioned this, that they're looking at that indicator as well. And as long as people have jobs, it's difficult to see them stopping spending.
Luis, let's talk about the reaction that we've seen in the bond market. Even here this morning, you are seeing yields fall just a bit. I'm curious just about some of the trends that you're watching there and what you think kind of that range bound looks like from here on out, given so much of this uncertainty.
Yeah, it's interesting when you see yields. Obviously, we had topped closer to like 470 at one point. And then as soon as the economic data started to roll in, and the economic data is telling you that the Fed is getting perhaps closer to being able to cut. Obviously, the Fed has wanted to cut for quite some time. They told us that since November of last year, based on their expectations. And just the fact that data was so strong, their hands are tight still, right? So yields, we see them pretty much flirting between that range, 4.25, 4.50 right now. And we think they're going to remain pretty much range bound for the rest of the year. There's no major catalyst to pretty much allow us to see rates falling even lower than that. And just doing a simple equation, if you look at just the real rates and you use a proxy like real growth about 2%, if you look at inflation expectations about 2.25, 250, that gives you essentially the nominal 10-year Treasury yield at 450. In other words, the market is not really considering any term premium right now. And there's a lot of risk out there in regards to the budget, in regards to the deficit, in regards to the amount of Treasury issuance that is not really being discounted at this point in time. So we think it's going to be really hard for Treasury yields to pretty much break below 4%, given the amount of pressure that you can get from that term premium.
Yeah, Luis, since you bring up the deficit, I want to talk about the debate last night. Both candidates were asked about the deficit, and there wasn't a lot of clarity about the extent to which they are going to address it in terms of actionable policies moving forward. I'm curious then, from your perspective, and you look at, the fixed income space in particular, do you think there's a likelihood here of bond vigilantes coming back into the space to force the deficit issue after November?
I would say there is. I would say at this point in time, the amount of outstanding debt, the amount of deficit that is projected, and we got recent projections from CBO, it pretty much tells you that there's going to be some sort of reaction from bonds. Like I mentioned, looking at that simple equation, in other words, the term premium is pretty much negative or at zero. And it's really difficult to kind of envision that moving forward, especially with the amount of spending. Obviously, we don't have a lot of clarity right now in regards to what candidates first of all, tell you in presidential debates, nevertheless, what they will actually be able to implement into actual policies, right? So it's a little bit difficult at this point in time, but we know that, some of the key components of spending is actually interest that the government has to pay on the amount of debt outstanding. And that is starting to get or binding more into that budget more and more. So obviously, it is in the interest of the government to see perhaps lower rates as well. And that's when you have conflicting views between the Fed as well, if they're really pretty much committed to honing in on inflation.
All right, Luis Alvarado, great to have you here at Wells Fargo Investment Institute Global Fixed Income Strategist. Thanks so much, Luis. Well, the first presidential debate capturing America's attention after President Biden and former President Trump went back and forth on key issues, including the economy, taxes, and foreign policy.
We got to take a look at what I was left when I became president and what Mr. Trump left me. The economy collapsed. There were no jobs.
The tax cuts spurred the greatest economy that we've ever seen just prior to COVID and even after COVID.
The fact is that the vast majority of constitutional scholars supported Roe when it was decided. The idea that states are able to do this is a little like saying we're going to turn civil rights back to the states.
As far as Russia and Ukraine, if we had a real president, a president that was respected by Putin, he would have never invaded Ukraine.
The only person on this stage is a convicted felon is the man I'm looking at right now.
He did beat Medicare. He beat it to death, and he's destroying Medicare because all of these people are coming in. They're putting them on Medicare. They're putting them on Social Security. They're going to destroy Social Security.
For more, we want to bring in Clayton Allen. He's your Asia Group's U.S. Director. Clayton, it's great to have you here. So let's take a step back because here we are this morning. We're about 40 minutes into the trading day. And I think investors at this point are trying to gauge whether or not we actually could see a new candidate put forward from the Democratic Party. I'm curious your reaction to what we heard last night and what that tells us just about some of the uncertainty that lies ahead.
Certainly, and thank you for having me on. I think the one major takeaway last night is that Biden had a bad night. The bar for him doing well was higher than Trump. Trump had to avoid appearing sort of disorganized or aggressive, and he largely did that. For about 80 minutes of the 90-minute debate, Trump kept his aggression in check. He avoided major blunders. Now, he fabricated and in some cases completely exaggerated any number of actual verifiable facts, but that doesn't matter much for the narrative. The takeaway from last night is that Biden looks old and he looks weaker than he did going in. So certainly that's stirring speculation that there could be a push to replace him.
Well, let's talk about that push. Our very own Rick Newman, who covers politics for us, said something that I thought was so powerful earlier, that Jill Biden is the most important person in America right now because she could drive that decision. What do you think about that? And what do you think the Democratic Party can do moving forward if the decision for the Biden camp is to stay in this election?
Absolutely. That's spot on. There's a lot of speculation this morning about who in the Democratic establishment could lean in and push Biden to step aside from the ticket. The Democratic establishment's the wrong place to look. It's the Biden family cell phone plan. Somebody on that cell phone plan is the only individual capable of convincing President Biden to step aside. If anyone else could have done it, they probably would have already tried. Right now, this is going to be a decision that only Joe and Jill Biden have control over. The signaling out of the White House this morning is that the president's in this. He's remaining in the race. He's going to win. Of course, that's the narrative you have to put out as a White House. You can't say anything else the morning after the debate.
Is this going to add to some of the volatility that we could see in the markets?
It could. I don't know that that's necessarily what I would expect. I think that the basic fact, the functional reality that we live in right now is that while there is a lot of media speculation about replacing President Biden at the top of the ticket, to actually do that faces some major hurdles. First of all, there's not a clear replacement at hand. Kamala Harris has the strongest case for it, but she's perceived as a weak candidate by a lot of people in the Democratic Party. There's also the question of primaries. The person at any replacement would be an appointed rather than an elected candidate, and that turns off big parts of the Democratic coalition. They're upset that their person wasn't called up to be the relief pitcher. In any case, you don't have a clear replacement. You don't have a clear process to do that. I think that if anything, we get a lot of speculation about a replacement, but it doesn't necessarily add to volatility about policy shifts or other changes shifting from a Biden to potentially a Trump administration.
Clayton, I also want to get your take on some of the policy decisions that were discussed in last night's debate, specifically with regards to tariffs. Let's take a listen.
It's not going to drive them higher. It's just going to cause countries that have been ripping us off for years, like China and many others, in all fairness to China, it's going to just force them to pay us a lot of money, reduce our deficit tremendously, and give us a lot of power for other things.
This tariff is 10% tariffs. Everything coming into the country, you know what the economists say? That's going to cost the average American $2,500 a year more, because they're going to have to pay the difference in food and all the things that were imported.
So, Clayton, I know we didn't get a ton of clarity there on the exact nature of these policies, and Trump has previously floated this idea of eliminating the U.S. income tax to sort of be replaced with these tariffs on these imports. But from your perspective here, at what point will the market start to really consider pricing in the potential impact of these tariffs if we do get a sense that Trump is starting to get ahead in the polls?
I think we're starting to see a lot of investors really pay attention to that and take the tariff threat seriously. The feedback we get from our clients is that people are generally of the mind that Trump has the much stronger edge in the campaign right now. People take him seriously when he talks about tariffs. I think the other takeaway from this is that people look at the sort of macroeconomic impacts, the inflationary impacts of tariffs, and recognize that Trump's narrative that this is other countries paying the U.S. is perhaps out of step with the way tariffs work in reality, that this will impose some inflationary pressure on U.S. consumers. That inflationary pressure could be exacerbated by immigration policy that raises labor costs across various sectors of the economy. And I think the feedback we get is that investors are increasingly cognizant and increasingly taking those potential impacts seriously.
What do you think that inflationary pressure could look like more specifically?
I don't have a good estimate of what the inflationary pressure could look like in terms of a percentage amount. I think that the takeaway that we would look at here is that there's a lot of policies that Trump has proposed which cumulatively would increase inflationary pressure across a lot of the economy. You also take into account the deficit growth under Trump, which we now can put numbers to. And I think that that paints a rather disturbing picture for U.S. fiscal policy. The takeaway is that deficits are increasing no matter who wins, but there's a potential that some of Trump's other policies could exacerbate that inflationary impact.
Clayton, how much do you think the Biden campaign needs to be concerned that the Fed has kept rates too high for too long, and that could put pressure on this economy as we get closer to November?
I think that that's a reasonable concern to raise. I think that Fed policy certainly is one of many factors that are shaping people's view of the economy, specifically as it relates to housing costs. The issue, though, is that Fed policy is not an immediate impact on voter sentiment. There's a delay between a decision at the Fed and people changing their minds in the ballot box. Remember, the first early ballots go out at the beginning of September. We're very much closing in on the end of this race. A Fed decision in even the next meeting would probably come too late to have any real impact on the election. So I think that it's a backward-looking risk that the Biden administration would be evaluating.
All right, we're going to have to leave it there, Clayton, but really appreciate you joining us. Thank you so much. That was Clayton Allen,
Thank you so much.
Eurasia Group's U.S. Director. We're going to have all of your markets action ahead. You're looking at green across your screen. A lot of strength. The Nasdaq hitting its highs for the day here, up 0.8%. You're watching Catalysts.
Alphabet getting a downgrade today. Rosenblatt cutting its rating to neutral. That's down from buy, trimming its price target by $1 there. We're looking at a loss of just about 0.2%. Now, the firm citing transitional risks in multiple areas that could impact search ad revenue. So we're seeing a bit of a reaction there in the stock. The analyst Barton Crockett also going on to say that he sees multiple areas of transitional risk that recommend stepping back for a little while to see how the company handles it. When he talks about those areas of risk, he says that it also includes the AI impact on search, what exactly that is going to look like, and also from a competition standpoint, that competition could really push Alphabet into a higher than anticipated CapEx spending cycle here for AI, Maddie.
Yeah, it's interesting too. One other line that sticks out, the transitioning of search ad revenue to retail media networks seems set to accelerate as other retailers like a Walmart follow Amazon's lead and push into this area. So potentially seeing some ad revenue pushing to the downside for a name like Alphabet. But this is very interesting. I remember speaking with an analyst for a piece I worked on recently on the series side about the fact that Google is not always going to be the best search engine for folks. And with AI, you can say something like, I am looking for the most affordable but best lasting coat available on the market, and it'll give you that exact product for that. That's something that's a lot harder to find on a platform like Google, and that's why we've seen the rise in social media influencing when it comes to products like that, because you can get a lot more specific. And I think that this note highlights a lot of that idea as well, the idea that AI is potentially going to be a better search engine than something like Google is able to provide for consumers right now, Shauna.
All right, let's take a look at UNH, United Health here. It's a trending ticker on Yahoo Finance. OptumRx, it's a prescription delivery service that operates as a subsidiary of that company of United Health, has agreed to pay $20 million to settle allegations over illegally filling opioid prescriptions. Now, shares of United Health are rising this morning, have been up more than 4%. We're now looking at a gain of just around 2.5%, so well off the highs of the day here. But again, the settlement adding a bit of clarity here on that path forward for the stock and removing some of that uncertainty that clearly had been an overhang here for United Health.
Yeah, it's interesting. I'm looking at a story on the Yahoo Finance platform right now showing that about half of this business is held by the top 18 shareholders of this stock. So seeing a lot of institutional money in UNH here. Also year to date, this stock really struggling. It's down about 7.5%, still up over the course of the past year. And it's also been down over the course of the past month. But of course, seeing that rise to the upside today following this news. Well, coming up, the federal deficit is a big issue for a lot of Americans, but while it was asked about during last night's presidential debate, it was not clear how each candidate would be responding to it. We're going to discuss investors' responses and the presidential candidates' responses as well after the break. Crude oil is hovering near a 2-month high as geopolitical tensions heighten in the Middle East. To discuss those developments, Yahoo Finance's Inez Ferre is here with us. Inez.
Yeah, Madison, and the market has been creeping higher over the last few weeks. The price of WTI now around just above $81 per barrel. You've got Brent crude that's just above 86 per barrel. We're seeing a little bit of a decline over the last 30 minutes or so, but nonetheless, we are expected to end for a third straight week of gains. We've seen escalating tensions in the Middle East. That's sending fuel prices higher. Israel fighting against Hamas, and now rising tensions with Hezbollah in Lebanon. Houthi rebels also stepping up some of their attacks on vessels. And remember that Iran is backing these groups, and so that puts the price of oil at these higher levels simply because Iran is such a big exporter of crude. So really, any interruption if there is any interruption to supply coming from Iran, that would be felt throughout the markets, and that is what these markets are pricing in here. I do want to pull up a 1-month chart so you can see where we're at with the action for the month. And year to date, just pulling up the year to date chart, Brent back at 13% gain for year to date, and WTI up 15% for the year. You do have interest rate expectations. Market's still anticipating a rate cut this year in the U.S. Europe already has started with theirs. So this will spur economic activity. So we did see some rising builds here in the U.S. This week that had caused some concern with demand here in the U.S. However, these rising tensions abroad, that's what's sending these prices higher. And I just want to take a quick peek at where we're at with some of the energy stocks. We're seeing a little bit of upward movement today, but just want to show you, I'm going to pull up a 7-day chart so you can see some of the rotation that we have seen into energy stocks over the last 7 trading sessions, guys.
All right, Inez, thank you so much for joining us on that. We appreciate it. Now, the FTSE Russell is set to rebalance the composition of its various indices today. That's historically led to a spike in trading activity and volume in particular. For more on this year's reconstitution, we've got Indrani D, FTSE Russell's head of global investment research, here with us in studio. Thank you so much for coming in today. We appreciate it. I just want to take a bigger step back and kind of walk our viewers through what this looks like, what it means. So talk to us about just the reconstitution in general.
Thanks for having me on this show. The Russell reconstitution is obviously, it's one of the biggest trading days in the year. And why it's so important is, as I always like to say, indices are a representation of the market. People want to invest in a market, and hence an index becomes very important. Hence, it should be representative of the market. So whatever is getting picked up in the reconstitution, it's picking up the underlying changes in the economy, which primarily is, large and growth doing so well. And in terms of industry, we are having so much innovation in the technology sector and healthcare, particularly biotech. And that's one of the biggest trends being picked up in the recon this year, that the largest number of companies moving into the Russell 1000 large cap space are from technology. And the largest number of additions into the small cap Russell 2000 are from health tech. So those are some really big trends that are getting picked up.
Yeah, I'm curious, when we take a step back and to also talk about just this massive run-up and this excitement surrounding AI, I guess more specifically the significance of this, and then when you look ahead, just the impact overall that this is going to have on the markets given that massive growth that we've seen.
That's very true. So just like, the markets on a macro backdrop, we are constantly talking about rates and growth. And similarly, in terms of a secular driver, AI today is almost like what the internet did in the 1990s, a big productivity boom. Initially, it starts in a certain part of the economy and then it broadens out. And I think we are seeing that because obviously technology getting bigger, the names that are coming into Russell 1000, many of them are AI-related, AI plays kind of thing. But I also think that innovation, the broadening out and the productivity gains is also one very important reason why biotechnology is seeing so much innovation. I think AI itself is broadening out, which has implications for the US economy and for the indices.
One question I had on that is in the tech names that have obviously had a strong year in the broader markets, SMCI is one of them. That's going to be going from the Russell 2000 to the Russell 1000. But so far since it was added to SPX, it's down over 20% since that joining. And I think that that's just an example that points to some of the concern with some of these tech names that a lot of investors have, right? That there's this hype cycle and then a bad earnings print and then, the bad news follows that. Is that a concern for the Russell 2000?
I think one of the biggest things that sets apart the Russell indices is how rules-driven quantitative it is, the whole process. It literally takes the human judgment out of it, which also makes for a very transparent process. Like since the rank day on April 30th, through May, through June, leading up to the actual reconstitution, we put out the preliminary names. People know what's going to come. So nothing takes the market by a total surprise. It is a very big trading day because obviously passive funds will need to rebalance, even active managers, in terms of their benchmark, what they need to do. But it's a very transparent process. And I always like to say indices, if they are quantitatively built to reflect the underlying economy, it's just going to pick up what's happening in the real economy.
I'm curious, though, how you're looking at just this massive concentration that we have seen in terms of the outperformance and maybe the risk that then does pose, more broadly speaking, to the market going forward, but also making it a bit tougher here for investors out there who are trying to mirror, trying to get an edge when only a handful of stocks really account for so much of the movement that we've seen and also broad weighting here of the indexes.
You're very correct that we have an enormous amount of concentration that's going on. There is concentration in the economy where you see most industries, the bigger are getting bigger to a lot of extent simply because they are more productive, resilient, call it whatever. But in terms of specific numbers like the Russell 3000, the entire market, year over year, it's grown about 20%. But the Magnificent Seven have grown, I'm talking market cap, 43%, 2.5 times the growth of the underlying overall market. So there is enormous concentration. However, I do believe as the AI story leads to more productivity gains and it spreads out across the economy, this concentration thing may abate a little bit simply because of the widening out of this productivity gain.
And Johnny D, it was great to have you here in studio this morning. Thanks so much for taking the time to join us here.
Glad to be here. Thank you.
All right, let's do a quick check of the markets. We're just over an hour into the trading day. We are still looking at gains here, although you can see we are just around the highs of the session. You now have the Dow up 237 points here. The S&P up about 0.7%. The Nasdaq leading the way, up nearly 1%. Now the moves higher, up 0.8%. So I guess that's a big rounding that I just did here. But the move higher coming following that PCE print that we got out this morning, showing that inflation once again improving just a bit. That disinflation story remaining intact. And then we also got consumer sentiment out at 10 a.m. Eastern time today. So again, having a big impact on some of the market's early moves. Keep right here on Yahoo Finance. You're watching Catalysts. The first presidential debate capturing America's attention after President Biden and former President Trump went back and forth on a number of issues. Now, just before the debate, when you take a look at the Real Clear Politics betting market average here, giving Trump an 18-point lead over President Biden following the debate, former President Trump's lead had expanded to over 32 points. Here to talk about that and more, we want to bring in Steve Pavlik. He is head of policy research at Renaissance Macro Research. Steve, it's great to have you here. So talk to us just about your reaction to the debate and what the markets are pricing in at this point, the odds here that maybe we could see a heck of a lot of uncertainty here over the coming weeks or days.
Well, sure. I think you have to go back to, the goal of the debate. You have two candidates that are relatively unpopular, and I think the intent from both was to put the focus on the other. And from that standpoint, I think that's where the Biden campaign fell short of expectations that were already low, to be honest. The fact that he wasn't able to clear that bar, given the concerns over his cognitive ability, I think is really a major factor for them now. And I think one thing to keep in mind is the fact that I think most voters are now starting to link some growing concerns about Biden's competence to these fears about his cognitive ability. And that's very difficult to convince people otherwise based on what they saw. So at this point, as you alluded to, we're seeing a movement in the betting markets. I believe now they're up over 35 points. And I think when you look at the CNN post-debate poll, 2/3 of viewers actually gave Trump the win there. So I think we're going to have to watch over the weekend, probably into the beginning of next week, is the potential progressive pivot away from Biden. At this point, there's a lot of pressure, I think, on the Biden team to have him drop out. And the messy process is who's going to replace Biden. Ordinarily, it would most likely be Kamala Harris, the vice president, but polls show that she's actually less popular than Joe Biden. So I'm not sure that's going to solve Democrats' electability challenge. At this point, looking at a Gallup poll, a lot of respondents sort of skeptical over what they perceive as policies that may be too progressive. I think that sort of hurts the chance for somebody like a Gavin Newsom to maybe jump in as a potential replacement. If you just look at the electoral map, I think more likely scenario is somebody like a Gretchen Whitmer, governor from Michigan, or maybe Josh Shapiro, the governor of Pennsylvania, to try to maybe preserve their chances of winning there and hopefully keeping the presidency. So that's sort of what I'm keeping an eye on for the next few days.
I think a big question just in terms of the commentary from normal people out there is this question about the Democratic strategy heading into this election and why there wasn't a bigger backup plan perhaps in place if voters were rebuffing President Biden because of concerns about his age. What do you make of that piece of this, the kind of question mark about the Democratic strategy here?
Well, they were sort of victims of their own success. If you look at the midterms, I think at the time there was this thought that this red wave was going to materialize based on the history of the party in power during midterm performance. That didn't really happen. So that would have been the logical time for Democrats to maybe make that pivot from Biden. Obviously, Biden and those that he employs want to stay in power. And so they sort of, at this point, have put Democrats in this uncomfortable position. Now, to be fair, this conversation has been going on for a while. You could argue it actually goes back to what some referred to as the Biden basement strategy in 2020 with respect to concerns about his age. And even in February, we saw reports from a number of progressive outlets suggesting that Democrats were already sort of preparing for a plan B. And the way that that would have to work is that Biden would have to agree to step aside, at which point his delegates would be free. And then we'd have a situation in Chicago, of all places, where you could have a contested convention. And you just sort of think back historically, I think the last time that happened there was 1968 when Lyndon Johnson, another Democratic president, agreed to step aside because he felt he was going to be a drag on the party.
When do you think the market is going to start really pricing in a potential for Donald Trump to become the next president?
Well, it depends on how you start looking at it and where you measure it from. I mean, today, if you look at Trump media, I believe pre-market they were up pretty substantially. I know that natural gas futures were up. That may have been some reflection, people playing greater confidence of Trump performing well. Our team has done some work with respect to the market actually performing higher, the correlation between that and Trump leading in the Real Clear Politics average of polls. I think we're still going to have to wait a few more weeks to get some polls that really capture the momentum here from the debate. In terms of when I think markets will be more certain, I think we'll probably know, again, within the next couple of weeks whether Biden's going to remain the candidate. If there is an effort to replace him, then I think that just injects a lot more uncertainty as to what that replacement would be and whether or not we're even going to have this second debate in September. So that's sort of how I would think about it.
All right, Steve Pavlik, head of policy research at Renaissance Macro Research. Thanks so much for joining us.
Thank you.
Well, President Biden's performance in the first presidential debate of the year for the 2024 election against former President Trump. Well, President Biden did struggle with his delivery at multiple points during the debate. Poor performance leaving voters increasingly concerned surrounding Biden's age and raising some questions about whether or not Democrats should replace him. Now, we spoke to a number of guests today about how a potential Biden dropout could happen and who could replace him as a Democratic nominee. Our very own Rick Newman here with more on that. And Rick, when we talk about some of that reaction that we did get here so far this morning, I think my takeaway so far is just the uncertainty that this leaves, the fact that we could see obviously a heck of a lot of changes between now and November, and we ultimately maybe don't know who's going to be on the ticket.
Well, it certainly got a lot more interesting. I mean, it's not so much just two boring guys we know everything about anymore. I mean, we now could end up with a new Democratic candidate who's somebody new to the scene. If it's somebody like Gretchen Whitmer, the governor of Michigan, or Josh Shapiro, the governor of Pennsylvania, who most Americans don't really know much about unless you live in those states. I would point out that I think the base case remains Biden is a candidate. And he has to step aside. I mean, he has to agree to step aside for somebody else to become the candidate. There's no indication yet that that's likely to happen. From the Biden campaign is pushing back aggressively on all of this today, saying, cut it out. Biden is the candidate. He's not going anywhere. So there's a lot more turmoil to come here.
Yeah.
And a question about whether or not he does have to step aside to win this election, given that former President Trump is still facing felony charges.
We have more surprises coming.
Right.
So let's not, the election is not tomorrow. And among the things we know are going to happen is Trump is going to get sentenced for the 34 criminal convictions in the New York case on July 11th. That is just a few days before the Republican convention. Some political analysts say that if Trump gets a jail sentence, could be a game changer in itself. That'd be more tangible to voters than just he was convicted of something they're not sure what. But if he actually gets a jail sentence, or he gets like a home detention sentence and he can't campaign, he has to stay in Florida. That changes things. Then we're probably next week, we're going to hear from the Supreme Court on whether one of the other three trials Trump faces can get started in Washington, D.C. That's the one relating to election interference and the 2021 riots at the Capitol. So there's a slim possibility that trial might still be able to get started before Election Day. We will find that out next week. And I mean, with two candidates this old, I mean, obviously there's a health. I mean, health is an issue. I mean, somebody could slip in the bathtub and it changes everything.
Oh God, that would be tragic. Hopefully that doesn't happen. Well, but Rick, what do you think the Democrats' strategy is going to look like, or maybe the better question is should look like here, at least over the coming days when this still remains in the headlines? The
strategy up till now was to make the campaign about Donald Trump. Biden just totally failed to do that in the debate. And remember, it was the Biden campaign that wanted the early debate. We've never had a debate this, almost 5 months before the election. The Biden campaign wanted that because they thought it would be their opportunity to reset the terms of the debate and get everybody focused on Trump. And the exact opposite happened. I mean, it was just a total disaster from a strategic perspective. So can they get, circumstances will help the Biden campaign, perhaps. So the sentencing on July 11th, that will help them try to turn it back against Trump. I mean, there's one other debate scheduled. And in theory, Biden has a chance to recover from a poor performance in this debate that was, a lot of swing voters probably didn't even watch it. So
does
that helps
matter
Biden.
when we have TikTok?
Yes, it matters. So the second debate will matter more because swing voters will be more tuned in. But I mean, Biden's going to be 3 months older. I mean, he's not getting younger; he's getting older. So if the underlying problem, by the way, I don't think Biden has dementia. He clearly has like memory recall issues, and he cannot express his. He loses his train of thought. That's not dementia, just to be clear. But it matters to voters. And if he cannot improve his performance, and I don't know why we should think he would improve his performance, because this is the guy. This is who he is right now. If he can, then he gets another shot in September. But it could just as well end up even worse in September. You have to keep that in mind.
All right, Rick. Well, I'm being yelled at to move on from this conversation, but I could ask you
Everybody wants to talk about this today.
I understand. We got to go. But thank you so much, Rick. Really appreciate your time. Coming up here, investors spending billions on the space industry. We're going to take a look at the return on that investment after this. Elon Musk, Jeff Bezos, and Richard Branson. These are the billionaires leading the space race, setting lofty goals for themselves and the future of space travel. Investors are buying in. So far this year, the space industry is getting $6.5 billion in PE investment. That's according to Space Capital. And this week, Bloomberg reported that SpaceX is selling shares that value the company at around $210 billion. But our next guest says it could take generations for the investments to pay off, even if they ever do. Joining us now to discuss, we've got Derek Pitts, the Franklin Institute's chief astronomer. Derek, it's great to have you here. Thanks so much for being here with us. I'm interested in your take just on billionaire investment in this space in general, given that you are a space expert yourself. How do you feel about it?
Well, it's really exciting that they're pouring all this cash into expanding our capability to reach low Earth orbit and beyond with organizations other than the national space organizations like NASA or Roscosmos of Russia or any of the others, Arianespace of France. But the issue here is that how is it that they're going to be able to actually generate some income out of this? Because right now, the billions that they're pouring in are going towards building the necessary infrastructure to do the work that has to be done off planet in space. And that is tremendously difficult. It has very high risk. It's going to cost a lot of money, and it's going to take a long time to get to a point where you actually have a process that's turning product around that can then generate some positive revenue for you.
So, Derek, for investors there that are looking to see some sort of return and maybe in a more timely fashion, I guess, what do you think in terms of that angle or the catalyst of what is going to change here for investors over the coming months? It's probably too short of a time frame here. Coming years, what do those investments maybe more accurately look like?
Well, I think those investments have to be looking toward what are the practical technologies that emerge from the development of all the technologies that are being developed to actually build this space infrastructure. I mean, what kinds of technologies coming out of this can be used here on Earth? And driving that kind of development actually is important and can work, because as those technologies are built for use in space, the application that they can have on Earth can actually develop an avenue in which those investments actually begin to pay off sometime sooner than 2 or 3 generations from now.
Throughout the course of your career, Derek, have you seen the kind of combination of the private and public sector have different impacts in terms of how much technological growth there is based on where the investment is coming from versus in each of those?
Well, the interesting thing is that on the public side, the money that's invested by governments does then turn into technology sharing for the rest of the general public or for that nation, because in terms of, for NASA at least anyway, technology sharing is part and parcel of the investment that our government is making in developing our national space program. But for private industry, what happens on the other side is they now have proprietary right to all of the technology that they develop. So in one sense, we have easier access to those technologies through the public sector, the national space organizations, than we do through the private sector.
All right, Derek Pitts, the Franklin Institute's chief astronomer. Thanks so much for joining us here this morning.
Thanks for having me this morning.
Financial Freestyle, it's a new collaboration between Yahoo Finance and Ross Mack. It's launching on July 1st at 12 p.m. Eastern Time. That's on Monday. Ross is an entrepreneur and he's an entertainer and a musician who has dedicated much of his time to giving back to his community. Let's take a listen.
At my core, I believe that if you work hard and you're as good as everybody else, the results should be the same. Mm-hmm. But what we're dealing with in this country, as you think about gaps, right, and these wealth gaps, is many people like my family, we're fighting from behind. Right? And you can do everything right. If you think about it, you can do everything right. Like you have people that work up, they do, wake up every morning, they do 40 hours a week of hard work. Yeah. You know what I mean? And they get and they're trying to just make ends meet, and they get to the end of their career yes, I'm retiring, this is great. And they retire and they don't have enough money.
And you will be able to catch Financial Freestyle's first episode July 1st, 12 p.m. Eastern Time on Monday. Don't forget it. It's going to be a great watch.
It's going to be a great watch, and so will our upcoming show, Wealth. It's dedicated to all your personal finance needs. Our very own Brad Smith is going to have you here for the next hour. Stay tuned and have a great weekend.
Welcome to Wealth, everyone. I'm Brad Smith, and this is Yahoo Finance's guide to building your financial footprint. Our community of experts will give you the resources, tools, tips, and tricks that you need to grow your money. Hey, on today's show, the Biden-Trump mashup in the first presidential debate of 2024. We'll talk about the issues important to consumers, like taxes, and what a Biden presidency versus a Trump presidency would mean for your wallet. And mortgage rates declined for a fourth straight week, but it's not all coming up roses for the market here. We'll talk to Redfin's chief economist, who will give both buyers and sellers some tips to live by. Plus, we're less than a week out from the July 4th holiday. We'll talk about what you'll be paying at the grocery store for this year's BBQ, that barbecue. But first, the latest PCE numbers, or Personal Consumption Expenditure Price Index, that showed core inflation in May rising 2.6% year over year, the lowest annual rate since March of 2021. So, what can this mean for the future of rate cuts and your portfolio? For more, let's bring in Michael Green, Simplify Asset Management's chief strategist here. You get a read like the one we got this morning here. What does that signal for the reality of what the rate policy pathway could look like from here, from your perspective, Michael?
Well, from my perspective, what we've seen is among the fastest slowing of inflation on a year-over-year basis, basically in history, really since 1972. So we've seen an extraordinary deceleration in the rate of inflation, and that's very frustrating for a lot of people because they're focused on the price level. You mentioned the barbecue. When we look at those costs, they are absolutely higher than they were 2 or 3 years ago, in some cases by a significant amount. But that rate of change has now slowed. And the real risk is that the rate of slowdown continues. We find ourselves in some areas of deflation going forward.
And so as we're continuing to monitor the daily undulations of the CME Fed Watch tool, what is your estimation for when we could see that first rate cut?
Well, I think there's an outside probability. Right now, the market is only pricing about a 10% probability of a rate cut in July. I think there's a reasonable chance that that should be a little bit higher, particularly because we have another CPI data point coming in the next month. One of the criteria, one of the dynamics that seems to be in play is that the seasonality has reasserted itself in a meaningful way when companies raise prices on an annual basis. They're catching up to price increases that happened last year over the residual of the year. That's created higher January and February prints for the past couple of years. And now we're seeing that back away. We could very well see a very positive inflation print coming in next month. That might very well open the door for those Fed rate cuts.
Let's talk about some asset management strategy as well then. If we do see a pull forward of that cutting cycle and when it begins, what does that mean for the markets as well, for people who are trying to figure out how to position their portfolio? Does that mean a pivot? Does it turn into a sell the news event when we start to see those cuts? How do they evaluate that?
So I think this is going to be the really interesting question because candidly, we actually don't know. We have a segment of the market that has done extraordinarily well, the high-flying technology names, the large cash-rich companies. At the same time, we're seeing struggling. Many of the companies in the Russell 2000 remain 20 to 30% off their highs from 2021. We're now seeing the risk that those could actually begin to decelerate faster if the economy begins to slow. So far, we've had a combination of high profit margins and relatively robust growth that has kept businesses largely on track. But we are, just like the population of the United States, the households in the United States, we're seeing a radical bifurcation where the weakest companies are getting weaker, the more credit sensitive companies are becoming more stressed. And at the same time, companies like Microsoft, Apple, et cetera, that have significant cash balances, no financing needs, they've done extraordinarily well. If that process starts to reverse fast enough, we could see relief for the smaller companies and the more leveraged companies. If it doesn't come fast enough, though, you start to enter what I call a phase change, where credit availability and credit ratings, effectively, credit performance begins to become a really critical issue. We've seen this in prior cycles. It's unclear whether the Fed is going to get ahead of that or allow itself to fall behind because of the fear of inflation.
Does relief for smaller companies trigger a rally for small caps that have been absent from some of the run-up that we've seen thus far this year?
That would be the hope, right? That you would begin to see the market start pricing in some of that relief and some of that improved opportunity. But again, these tend to be economically cyclical companies. They're continuing to operate with relatively high margins. And so if we start to see that deteriorate, it's just a question of, does it happen too fast for the Fed to actually react?
Michael Green, Simplify Asset Management Chief Strategist. Thanks so much for taking the time here with us, Michael. Really appreciate it.
It was a real pleasure. Thank you.
Certainly. Well, last night's presidential debate did little to help alleviate concerns about both President Biden's age and former President Trump's temperament. But how did the two candidates do on the substantive questions that affect consumers' lives? For more, let's bring in Yahoo Finance's Rick Newman, who was sitting in front of whatever screen you consume this on, I imagine, with a bowl of popcorn and a pen and paper ready.
Yeah, something like that.
Something like that. Okay, so first, Rick, on top of minds for many Americans, among other things, inflation specifically. Let's take a listen to what they had to say on this matter.
We got to take a look at what I was left when I became president and what Mr. Trump left me. The economy collapsed. There were no jobs. It was terrible. And so what we had to do is try to put things back together again. There's more to be done. Working class people are still in trouble. I come of a household where the kitchen table, if the things weren't able to be met during the month, it was a problem.
We had the greatest economy in the history of our country. We have never done so well. The thing we never got the credit for is getting us out of that COVID mess. He created mandates that was a disaster for our country. He has not done a good job. He's done a poor job, and inflation's killing our country. It is absolutely killing us.
Okay, so what our viewers saw there had to be edited because of rants and because of what was indecipherable. But from what you heard from two of the candidates here on inflation, where do we kind of see the chips fall?
Okay, they're talking about the past. That whole conversation was about what happened 3 and 4 years ago. Each of them trying to blame the other for the bad things about the economy and take credit for the good things about the economy. Does that matter? I mean, what I think voters want to hear is what's the plan for the next 4 years, not what happened during the last 4 years. But I guess you could argue that this does matter because people you need to know whether they trust Donald Trump more on the economy or Joe Biden on the economy. Polls show they tend to trust Donald Trump more. So I guess some people buy that, what Trump said about it was the best economy ever. That's not exactly right. But neither of them had much to say about what they plan to do in the future. I will say this. Trump does favor this 10% tariff on all imports and a big 60% new tariff on Chinese imports. Biden did bring that up. Biden was right when he said there are a lot of economists who say that would add a couple $1,000s a year to the typical family's expenses. That is not good. Trump denies that Americans would pay those tariffs, but a tariff is a tax on top of the cost. It just gets passed on to consumers.
Right. Another issue that American consumers are concerned about is the availability of their Medicare and Social Security. Did either candidate say anything worthwhile on that matter?
Thank you for adding that adjective, worthwhile. They both talked about it, and you got zero clarity on what's the status of either of these two programs. From either one of these guys, because again, they just used hyperbole and each tried to blame the other or say the other would wreck Medicare and Social Security, or that each is responsible for the precarious state of the finances for these plans. The reality is these plans are, everybody has seen this coming like a slow train down the tracks for years. Both of these plans are going to run short of money within the next 6, 7, 8 years. It changes a little bit every year based on how the economy is doing and tax receipts that come in. But we're going to need fixes. Biden does have a plan to fix both of these programs. He wants to raise taxes a little bit. I don't think he did a very good job of explaining that last night. Biden just gets lost in the details and the weeds of things he's trying to explain, and he just can't get a clear message out there. And Trump is less clear about how he would fix these programs. He's talked a little bit about trimming benefits. When it comes time to actually do it, I don't think voters are going to like that very much, but we're not there quite yet.
You know, on the other matter here that is very personal finance, household finance related as well, because it is a family decision when you talk about student debt and childcare, two topics front of mind, especially for Gen Z and for millennial voters here. Did there seem to be any concentration of thought around how these candidates would address either of those matters?
No. Sorry. Biden did, there was basically no discussion about student debt. Biden is trying, you and I have discussed this many times before, Biden's trying through a different range of executive orders to cancel debt or forgive some of it or make it easier to pay back through a bunch of different programs that's being challenged in court. Biden did bring up childcare in the context of what to do about the expiring tax cuts. Trump wants to make them all permanent, leave all the tax cuts in place, including for the wealthy. Biden is trying to make the point, look, we could use some of that money. Wealthy people don't need the tax cut. Let's put tax rates for the wealthy back to where they were before the tax cuts. That will bring in more revenue. We can use that for things such as childcare, and that's about as much of a mention as it got. And I doubt anybody even noticed because it was in one of Biden's laundry lists. He didn't really stop to talk much about that, but it was in there if you look hard enough.
Rick, thanks so much for continuing to track everything taking place within the lead up to this general election and breaking it down for us. Appreciate it.
Yep.
Another topic important for American consumers to hear from their presidential candidates, their plans for our taxes. When asked about tax policy during the first presidential debate, President Biden and former President Trump mostly argued about Trump's 2017 tax cuts. Here's what they had to say.
The tax cuts spurred the greatest economy that we've ever seen just prior to COVID and even after COVID.
That $2 trillion tax cut benefited the very wealthy. What I'm going to do is fix the tax system.
So what do we need to know about each candidate's tax policies? We've got Daniel Geltrude, founder of Geltrude & Company, here with us. Dan, good to see you. Thanks so much for hopping on. So from what we could decipher about what either of the tax agendas would be, what do you make of it, and what should the American people actually take away from the debate on the topic of tax?
Well, we didn't get a lot from the debate last night. Most of what we know about potential tax proposals really relates to what they've said outside of the debate. As you just said, there wasn't a lot of detail there, but I could tell you where I think each of them are lining up. Now, let's start with this because it's an important point, Brad, is that unless whoever wins the presidency is going to have both houses of Congress, it is very unlikely that there are going to be tax changes because you're going to have gridlock, especially over a topic like taxes, which becomes very sensitive. Now, what will happen, again, as you just talked about, is the Trump tax cuts will sunset at the end of 2025. So if nothing happens in terms of new legislation with taxes, we are going to go back to what the tax laws were for individuals, that is, of what it was in 2016. So we're just going to go back from where we started 8 years ago. Now, the big picture here is that Trump is talking about more tax cuts, specifically that he wants to make the individual tax cuts permanent from back in 2017. He's looking to, once again, cut potentially corporate income tax. He said that he does not want to tax tips from those who work in service industries. I also think you're going to see Donald Trump do some defunding potentially of the IRS, which came about from the Inflation Reduction Act. You know, there was a lot of talk about all these auditors. I think Donald Trump may very well make a move to undo that funding. And I also think we could see some cuts in capital gains tax. Biden, on the other hand, probably is going to propose the exact opposite. He's talked about more taxes on the wealthy, so you would see individual tax rates going up. You're going to definitely see a proposal to change the corporate income tax because he said many times corporations don't pay their fair share. We could see some changes on capital gains tax rate. We could see a wealth tax on billionaires. So there's a lot in play. But again, nothing happens unless you have both houses of Congress.
Yeah, that's a key reminder here, and it certainly does come down to some of the other down ballot voting, as you were mentioning as well, for those offices, particularly, Dan, as we think about some of the tax credits that have been allowed. I mean, there's been everything from EV tax credits to child tax credits for households that are trying to wrap their minds around what may change, what may get taken off the table and have a significant impact to their own personal economy, if you will. What is this signal, and what are some of the larger items that could roll off that reframe that household financial balance, if you will?
Well, what I think happens there, as far as any tax credits that you brought up, is that with EVs, I do not see Donald Trump putting any tax credits out there related to EVs. And, as he alluded to, he does want clean water and clean air, but he is not talking about really having any type of major climate initiatives, where Joe Biden is really the exact opposite. So I think we could see a lot more going on related to credits for the environment. Now, as far as what would happen with families, they both may align very well related to having child care tax credits, because there's a lot of voters that matters for. But keep in mind, no matter who wins this election, right, they're going to be a one-termer, or it's just going to be the next 4 years. So that does give them flexibility to not have to worry about re-election. So they'll probably push really hard to make changes. What will pull them back, and it could even come from their own political parties in Congress, is those in Congress that have to worry about re-election are going to be very, very sensitive to voters' pocketbooks, because that's always an issue for people. It's not how much you make, it's how much you keep that's most important for anyone who's paying taxes in the United States.
Yeah, a very pivotal next administration, or next 4 years of the presidency, and all of the people that are serving within that as well. And so this could be a critical election to track going into it. Dan Geltrude, founder of Geltrude and Company. Appreciate it, Dan.
Thanks, Brad.
Certainly. Coming up, everyone, mortgage rates are on the decline. We'll talk to Redfin's chief economist to get some tips and tricks for home buyers and sellers. Plus, the conclusion of Yahoo Finance's Space Race Week. We'll talk to 2 astronauts live from space. Plus, defining your net worth. What is net worth and why it is important? Our personal finance reporter will fill you in. That's coming up. Turning now to the housing market. Mortgage rates are declining for a fourth straight week. Here with the numbers, we've got Yahoo Finance's Danny Romero. Hey, Danny.
Brad, mortgage rates fell to their lowest level since early April. Rates are down for 4 consecutive weeks. The average 30-year fixed mortgage rate ticked down to 6.86% as of June 27th. Freddie Mac data shows now, despite the pullback in borrowing costs over the past month, rates are still flirting around that 7% level. Millions of households are locked up into a cheap mortgage, which could be a reason why consumer spending has been so resilient in the face of higher interest rates. Still, potential home buyers are facing affordability challenges, which is impacting housing activity. Pending home sales, a leading indicator for the housing sector, fell 2.1% in May, according to the National Association of Realtors. Now, with a tight housing supply, home prices have pushed higher, shrinking the pool of buyers who can afford a home. Now, a household earning $100,000 a year can only afford 37% of home listings today. Now, how long could it take to unlock the housing market? Economists at Capital Economics think that mortgage rates would need to fall closer to 5% for supply to start normalizing. So this housing recovery might take longer than expected, Brad.
All right, Danny Romero, thank you so much, tracking all things housing. Let's keep with the housing market. Redfin has a new report out revealing for the first time since the start of the pandemic, the typical U.S. home is selling for less than list price. Here with more, we've got Daryl Fairweather, who is the chief economist at Redfin. Daryl, always a pleasure to grab some time with you. Can you help us break down what you're seeing in the data here, as it was really for the 4 weeks ending June 23rd here, where this typical home was selling for less than its list price?
We're starting to see some early softening in the market. Homes taking a bit longer to sell. They're selling for under asking price on average. And that means that buyers are getting a little bit more negotiating power. Those listed prices, they shouldn't be taken as the end all be all. You can come in with an offer under asking price, especially if it's a home that's been sitting on the market for a while.
What are we seeing in the new listings right now? How is that kind of moving in the market as of this juncture?
New listings are up. They're not up enough to get us back to levels of 2022 or before that, but they are an improvement from last year, which is why we're starting to see more competition among sellers to lower their prices, more price drops, home selling for below asking. There's a bit more pressure on sellers to meet buyers where they're at. They're having to work a bit harder.
Is that perhaps leading to more staleness for some of the older listings? And then where does that kind of also impact the pricing situation too?
Well, by historical standards, this is still very much a seller's market. If you price appropriately, your home will sell quickly with multiple offers. But there are some homeowners who really need a lot of money to move, probably because they have those super low mortgage rates from before. And maybe they'll just delist their home instead of having it sell for a price that's too low for them.
Where should buyers expect some relief when you feel like, and you are navigating an environment where we're looking at these all-time high home prices here on average? Where should buyers perhaps be able to say, okay, or at least chart their own path into entry into this market?
Well, it is difficult, but not in every single market. In places like Florida and Texas, the market is softening even more. So I think buyers can have more negotiating power there. Another bit of silver lining is that mortgage rates are likely going to fall. We got some good inflation data just today. So that's a sign that the Fed will probably cut later this year, and we may see lower mortgage rates because of that.
Mortgage rates have come down from May's 6-month high. Weekly average still just under about 7% here. And so if we do see that cut, what type of perhaps wave of new buyers are we expecting to emerge?
Buyers are so sensitive to rates that any little movement in rates will pull some back into the market. So I expect that if rates come down, we'll get buyers back in the market, and we'll kind of be back where we are in terms of affordability. There may be a slight window where rates come down before prices reaccelerate, but timing that can be very difficult, especially when there's so few homes for sale. I think buyers should focus more on finding the home that's right for them, that fits within their budget, instead of trying to time the market to save some money.
Okay, I want to end here with some actionable tips for those who are going out this weekend, trying to scout out some properties, or perhaps even those that have a property listed. Let's start with the buyers, though. What are some tips for buyers who are charting their own path this weekend and trying to see what seems right for them and what's within their price range?
Well, the most important thing is to stay within your budget. It can be really dangerous to go above and beyond because you're not putting money towards savings, and that can be just dangerous. So just make sure you stick to your budget. Even though prices are high and mortgage rates are high, don't go too far with your offer. The second thing is to know that homes that have been on the market for longer are probably going to sell for under their listed price, or they will have a price drop at some point. So keeping an eye out for those listings that have been overlooked can be a way to get a deal. And then finally, we do anticipate that mortgage rates will fall. But like I said, I don't think it's the best idea to try to time that because there will be more competition later. So just focusing on what's within your control, like your budget and the listings that are out there, I think is the best way to go about it.
All right, we do have to leave things there. You did send us 2 tips for sellers here, though. Be realistic about pricing. Prep work is key. Great advice there. Daryl Fairweather, who is the chief economist over at Redfin. Thanks so much for taking the time today.
Thank you.
Certainly. Coming up, everyone, I get to speak to 2 astronauts who are currently in space on the International Space Station, the ISS, as you know it in your hood, as part of Yahoo Finance's Space Week. That's coming to you next. The International Space Station orbits at an altitude on average of about 250 miles from Earth at around 17,500 miles per hour. And I get to speak to 2 astronauts live from the ISS right now. We have Jeanette Epps and Tracy Dyson. They are NASA astronauts and flight engineers for Expedition 71. This is Brad Smith with Yahoo Finance. How do you hear me?
Brad, we hear you loud and clear. How us?
Wonderful. Hear you clearly. What is the current mission that you're on, and what are you hoping to achieve while at the ISS?
Well, I think our current mission could be characterized as ongoing. And so though the people change, the mission stays the same. We're here to do science. We're here to learn about how to live and work and explore space. And the people that are up here doing the work are just trying to keep the motor running, if you will.
And we also add to the data that they collect for space. So we in and of ourselves, we're experiments as well. So we're here to contribute to all the knowledge that we gain from living here on the International Space Station for future exploration.
Talk to us about what a long duration mission is and what specifics go into some of the research that you're conducting.
You want me? Okay, I'll do one. Okay. Go ahead. Well, just this week, some of the research that I got to participate in is the materials science lab. And what that's looking at is the solidification process of metal alloys. And so we look at how the solidification process changes without gravity. And investigating these properties will help us make better metal alloys on Earth and for space.
Okay, and we're going to talk about zero gravity.
And long duration.
Okay, we're going to talk about. Yes, go ahead. I'm sorry.
No, I just was going to address the first part of your question of what long duration was. And each one of us are up here for about 6 months, and that's considered long duration, 6 months or more.
Wow. And so, Tracy, while you have the microphone, I see that you're both seemingly in zero gravity right now. How do you deal with zero gravity?
Well, handrails really help, and we just learned to appreciate and respect microgravity and try to work with it rather than against it.
Certainly. Jeanette?
Yeah, microgravity is hard to get used to, and you kind of have to give into it, and just instead of controlling things like we would on Earth. And here we have to use very light forces and let our bodies float. We don't fall, so we're relatively safe, but just letting life without gravity take place.
When you think about the amount of people that are signing up for space tourism and want to experience what you're experiencing right now in zero gravity, how do you think this is going to change the broader landscape for how people appreciate space?
What comes to mind is that there are a lot of fun aspects to being in space. I mean, floating is one of them. This sensation that we have right now, it seems kind of normal to us because we've been up here for several months. But it's really neat, the kind of things that you can do in the absence of gravity, not just the fun things that we get to do like float and do stupid astronaut tricks, but also the science can be quite fascinating when you remove that component. But I'll tell you what, the space environment and microgravity are very challenging. And so I would say that there's a lot that you have to not only overcome, but just lower your expectations of your own ability to adapt to it at first, because what you knew of your life with gravity is so different than your life without it.
That's perfect. No, I don't.
To me, there is no such thing as a stupid astronaut trick. This all seems very complex to us mere earthlings that are down here trying to figure out just how to make sure that we don't trip when we walk. So we got to know, what is your own schedule like on a daily basis?
Well, I can give you today, for example. The schedule changes every day, but today on my schedule, I had exercise first. Exercise is one of the most important things we do for our health, but it's also adding to the data that we collect here on the International Space Station. So I had to do weightlifting, and then I had to do the treadmill. And so I had to do 3 miles on the treadmill after lifting. You know, today was my heaviest day, so I'm going to sleep pretty well tonight. And then after that, I had several tasks to help maintain the station. So I was working here in the Japanese module, working on their environmental monitoring sensors and making sure that those work well. And so the other part of the day was also looking at stowage and logistics on board, because we don't have as much logistics storage area as you think. And then after that, we had a meeting, and then you have lunch, and then we had another earlier recording that we had to do, and here we are right now.
I would love to know as well, when you think about the overlap and the combination of the privatization of the space industry and still the public sector and how these forces have come together, how has that elevated the work that you're able to do, and perhaps how has it changed it over time?
You know, we could probably talk about that aspect of space exploration longer than we have time for today. But I would say that one thing it's done is add a lot of complexity to what we already do. And there's so many facets to that. One of them is that, you know, NASA, we've had a very long history in space exploration, our relationship with our international partners, to most notably with our Russian colleagues, and we've developed a culture. And when you bring in the privatization and the commercial and industrialization of space, it adds a component that that highlights the word cooperation, and learning how to do that, learning how to develop another culture. It takes time. It's quite a frontier. So I would say it adds a lot of complexity, but then again, there's so much more that we learn about the way we do business ourselves and our whole mission by expanding the circle and including those communities like privatization and commercialization.
Absolutely. We need to leave the discussion there, but as you were mentioning, you have space tricks that you've developed over time. Can we just see one real quick before we let you go?
Okay, we'll try this.
Okay.
But if it doesn't work, but we'll try it.
Remember, you have to lower your expectations.
Yes, stand by.
Wow. Wow. Okay, there we go. That's a perfect way to end this conversation. Thank you so much for taking the time here today, breaking down your own experience from the International Space Station. Jeanette Epps and Tracy Dyson, they're NASA astronauts and flight engineers for Expedition 71. Great to see you.
Thanks so much, Brad.
Thank you.
Thank you, Brad.
Everyone, we'll be right back on the other side of this short break with much more Yahoo Finance. Are you planning your 4th of July barbecue? Find out just how pricey your festivities might get as we break down the cost of everything from burgers to beer. That's next. Nike shares slipping, falling, can't get up right now after cutting its full year revenue guidance. The retailer saying that there's more pressure weighing on consumers and customers. Here to discuss what the earnings report tells us about consumers, Yahoo Finance's very own Julie Hyman is here. Hey, Julie.
Hi there. So I know this is one of your favorite topics to talk about the shoe universe, being the sneakerhead that you are. Unfortunately, the number's not looking so good for Nike, and the shares are actually having their biggest one-day decline in 23 years, Brad.
Thanks.
So when you look at these numbers here, and I'll talk about what this means for the consumer in a second, you saw a decline in the first quarter in that revenue number of 1.7%, and Nike is now saying that that will decline 10% in its fiscal first quarter, which is what we're in right now, and that for the full year, we will see a decline, in the low single digits here for that revenue. So what is going on in Nike? Well, part of it is a Nike problem. Part of it is a macro problem, right? We saw the sales weak in China in particular, but I talked to Anisha Sherman, who covers the company over at Bernstein this morning, and she said what we're seeing is kind of a little bit of both. So you've got a choosier consumer because the consumer is more stretched. You compare this, she said, to the period a couple of years ago when they were seeing big gains in revenue and people had money because of stimulus, credit card delinquencies were lower, we were seeing bigger wage gains. Now all of those elements have moderated at the same time that Nike is not innovating. So in other words, I don't know what your shoe shopping habits have been like recently, but she said what we're seeing, not just at Nike, but across the board, is that there has to be more newness, more innovation, more reasons for people to buy if they're going to be spending that money, that the retailers have to sort of take it the extra mile.
Mm-hmm. Yeah, mine is right now all the stuff that my parents didn't get me when I was growing up. So there's the nostalgia factor and there's the, hey, I can finally do it, I'll get it. But then there's also the thought process for a lot of consumers that emerges, okay, I should have enough at this point. And I think that's where a lot of people are kind of pushing back even on some of those purchases that they would deem as more nostalgic, even if Nike has leaned into certain parts of that brand to emanate that.
Well, so now Nike is sort of trying to refresh a lot of its existing brands, but she said that's going to be a difficult transition. The company itself has said that as well, as we kind of wait to see how those new models are going to be received. But again, it is not just with Nike. As Anisha pointed out, Tapestry similarly cut its outlook, but is still seeing strong demand for newer, in Coach, for example, for the newest bags, for the freshest stuff. It's not that consumers don't want anything, but they really need to be persuaded in order to be buying this new stuff. What I like to hear, Sam Poser recently of Williams Trading came out with sort of some negative commentary on Nike, and he said Nike is in a push model situation where they're really trying to convince people. There's not a pull from consumers. It's not like anything Nike does, it gets snapped up. They really are trying to push some new stuff on consumers, and consumers are not convinced.
Yeah, it's been interesting, especially within this consumer environment. The Olympics, a big potential showcase environment for a lot of different brands internationally. Nike sounds like they're going to be banking on that a little bit more.
They are a little bit, but it is telling that, again, in this current quarter, they're looking for a 10% revenue decline.
Right.
And then declines are expected to moderate in the second half of the year.
Innovation costs money. All right. Julie, thanks so much. Appreciate it. There's a look at Nike's revenue percent change.
Yeah.
All right, let's switch gears here. Let's talk a little 4th of July here. Independence Day, less than a week away. So get ready to fire up those grills as more Americans plan on hosting 4th of July celebrations. And if you have to have a barbecue, or you plan to have one, this 4th of July weekend, most of the fixings will cost more due to sizzling inflation. Yahoo Finance senior reporter Brooke DePalma is here with the breakdown. All right, Brooke, what do we know about what the cost of what you're throwing on the grill is going to look like?
Well, Brad, it's going to cost more than last year, but Americans do expect to spend about $3 less. Let's break it all down. Consumers, they're gearing up for their 4th of July holiday. Like I said, Americans plan to spend an average of $90 on food alone this 4th of July, and that's according to the National Retail Federation. And that's actually $3 cheaper than what they planned to spend last year. So how can you get the best bang for your buck? Well, Wells Fargo told Yahoo Finance It really depends on what exactly you buy. Let's break this all down, how this fourth is comparing to last year by taking a closer look at the latest consumer price index that we have from the month of May, kicking off with protein, of course, the star of the event. The cost of beef, well, that's going to be up about 4.9%. Hot dogs, frankfurters, that's going to be up about 7.3% compared to last year. But chicken here, well, that might be the way to go if you're looking to save. That's up just 1.4% year over year. And you can't have a barbecue without some sides and dips. If you're looking at potato chips, those will also cost more, up roughly 2.7% compared to last year. And to wash it all down, when it comes to drinks, let's talk soda here. You're getting the best bang for your buck by getting those 2-liter bottles compared to cans. Aluminum, that's still driving the cost of cans higher. And while most Americans typically do barbecue at home for 4th of July, they don't tend to go out to those restaurants. That is where you're going to get the most for your money as inflation at restaurants and bars continues to push the overall food inflation number higher. And Wells Fargo outlined just that. They gave this example here. The cost of a burger at home with all the fixings, things cheese, tomato, lettuce. At home, that one burger will cost roughly $2.15. Now that's compared to roughly $7 when dining out. But this holiday, as we've seen and we've heard so far this year, consumers are really looking for their best bang for their buck. They're really seeking those value deals, especially when it comes to groceries. So two stocks that I'll be watching right here, Walmart and Target, those two retailers really doubling down on low prices. Last month, Target announced plans to cut prices on roughly 5,000 items. We heard last month that they already cut prices on 1,500. And consumers will also be looking to buy in bulk. They want to get the most for their money here. So I'll have my eye on the wholesale retailers. Think Costco, think Walmart, Sam's Club, and also think BJ's Wholesale Club as well.
Yeah, that basil, pesto, butter, salmon at Costco, pretty good. I would highly recommend it for anyone planning to grill. Brooke, appreciate it. Much more wealth after the break, everyone. You're watching Yahoo Finance. The median net worth for families in the U.S. was a little bit over $192,000, according to the Federal Reserve. But what exactly is net worth and why is it important? So, to break it down for us, we've got Yahoo Finance's very own Molly Moorhead here with us. I mean, what is it at the end of the day?
Well, literally, it is what you own minus what you owe. And the reason it matters is it's a good gauge of where you are financially, your financial health. It's like a personal economic indicator of how you're doing.
Okay, so we're looking at the calculation here on the screen, I mean, what else is taken into account when we think about what you own versus what you owe here?
Yeah. So what you own are your assets, and you're going to add up all your balances in your bank accounts, your balances in your retirement or investment accounts. If you own real property like a home, all of that minus your debts. So if you have student loans, if you have a mortgage, anything you owe money on is subtracted from the total of your assets, and that gives you a number that is, generally speaking, lower the younger you are. It might even be negative if you graduate college and you've got a bunch of student debt. But then over time, the hope would be as your salary increases, your investments grow, that the number of your net worth will increase.
So once you calculate it, how do you track your net worth over time?
Yeah, so your financial advisor is a great resource here. They can kind of give you that big picture look, and they'll show you how you're doing toward bringing up your net worth. And then, your bank or if you have a Fidelity or Vanguard account, they often can let you link all your accounts, plug in all your numbers, and it'll show it to you. Or you can do, the old school spreadsheet. And it really is a good idea to track it because I think it can be motivating. So and I'm not saying track it every week, but a couple times a year you see that, that debt number come down as you're paying off, a credit card or whatever. And the money you're putting in savings is growing.
All right, Molly Moorhead with the breakdown on net worth. Thanks so much.
Thanks, Brad.
Absolutely. Think of some traits needed to succeed in business: strong negotiation skills, people skills, risk-taking, discipline, and an unlikely place you might see some of those skills in action: poker. Around 95% of professional poker players are male, according to Zippia. Our next guest's mission is to teach more women poker skills to strengthen the business and life skills. And for more on this, Jenna Just, Peak Six and Poker Power co-founder, joins us now. Jenna, great to have you here on the program with us. We just ran through some of the skill sets that can be developed while playing poker. Of course, there's the poker face, there's negotiation that can really tie into when you're trying to get a new job. What are some of those top skills that you see transferable from the poker table all the way into the business environment?
Well, Brad, thank you so much for having me here today. And we're super excited to share this information because, ironically, this game has been around for hundreds of years and women have not played it. And poker can teach you skills and create incredible toolbox for women. In particular, the skills we care about: teaching strategy, teaching capital allocation, and teaching risk-taking.
And so, Jenny, when you think about getting more women into poker, what is Poker Power and Peak Six doing to make sure that you see more people flowing into? Do we call it sport? Do we call it game? What
we call it a mind sport. We love it. We call it a mind sport.
Mind sport.
It's a game of skill. Yes.
Absolutely. Yeah, so how do you go about this?
Yeah, so we're definitely on a mission. We want to teach the first 1 million girls and women that have ever played. And most important is that we have our male allies supporting us doing this because there's no reason. It's just a card game. So how we started was actually with my daughter. And today we are teaching, and when she was 14, and today we're teaching everyone from 10 to senior corporate women. We are out in the marketplace. In the last 3 years, we've taught at over 280 companies and organizations in 40 countries, which is just incredible that they're all on board to learn this game and understand the benefits of doing it. When we sit at the table, men have been doing this for years. They do it because it's fun, right? And so, first of all, we're having a lot of fun. Second of all, we're networking together, which men have also been taking advantage of that over the years. But most important, we learned this early on with one of our U.S. bank clients who took their senior women and their clients together to do our Poker 101. And the next morning, this senior woman wrote me a note: exhilarating event. In one sentence, I realized I wasn't playing to win. This game can help women practice learning this skill on how to win. Because it's not about how not to lose.
Right.
It's playing to win. And that's what we're teaching them at Poker Power.
Just lastly, while we have you, we only have about 45 seconds here, but when we think about the annexation that a lot of people give to the stock market, some people calling it gambling sometimes, whereas poker really is and can be gambling. And I mean, it is thrown into that realm. You know, how do you kind of decipher between the two and make sure that you're not taking a gambler's mindset into something that is investing and has more strategy around it?
It's really incredible. What I love about poker is we have the opportunity to teach and practice negotiation. There is no money exchanged at Poker Power. And women are learning these skills every single day when they sit at the table with us. They're learning how to strategize. They're learning how to adjust and be flexible about their strategy. They're learning to weigh risk versus reward, not just avoid risk. And most important, they're learning how to negotiate with a person. At the end of the day, poker is not about the cards. It's about the people at the table. And where else in the world do you get to practice negotiating versus actually negotiating? So it's an enormous opportunity for women to practice since they're not doing it in their hobbies and their play when they're young. So we're super excited for your audience to join us and bring the women and girls in their lives.
Jenny Just, who is the Peak Six and Poker Power co-founder. Thanks so much for taking the time here with us today, and CEO, I should say, of Poker Power. Don't want to leave that title off. Thank you so much, Jenny.
Thank you so much.
Absolutely. Everyone, that's it for Wealth. I'm Brad Smith. Thank you so much for watching. You could stay tuned for Market Domination. Julie Hyman and Josh Lipton got you at 3 p.m. Eastern Time. You do not want to miss it.